Print yesterday in the U.S. that's really riled markets because they didn't really know what to do with it. For sure, we heard about inflation. Central banks keep on telling us that actually inflation is here, but it's transitory. When you look at some of those prints, the highest in 1990, it's very difficult not to worry about what it does in the long term. If you look at the DAX futures, they're pretty much unchanged, but it'll be interesting to see how the day develops, looking at treasuries and all of that, Tom.
Yeah, and increasingly you have that divergence between what central banks are saying and what the economists and strategists are saying. Is it time now to finally put that term of transitory to bed, given that very strong inflation print that we had, not just out of the US, but out of China and Japan as well? The Spanish IBEX is down 0.2%. The CAC 40 is also lower by 0.1%. The FTSE 100 is flat. We had that GDP print for the month, 0.6% coming in above the estimates. Quarter on quarter, just slightly weaker. How that plays into the decision-making by the Bank of England as they gear up for what some expect to be a rate hike next month will be in focus. We can change it on to see what some of the cross assets are looking like then. Cash treasuries are not trading day today because of a holiday, but we can have a look at the futures. By the way, Italy gaining, or down, I should say, 0.1%. Here's the cross asset board then we want to draw to your attention. Down about 0.1% in terms of the pressure, a little bit on the US 10-year, so we expect to see yields higher when that treasury trading starts and resumes. The dollar indexes should be in focus as well. Gains of 0.2%, how that plays out, particularly in emerging markets. Strength there for the US dollar. In terms of WTI, you're seeing gains of 0.1%. And S&P futures pointing to gains after the sell-off that we saw yesterday. Investors and some strategists saying there's still plenty of cash on the sidelines. We'll get that view from Barclays chief strategist just in the next few minutes. But currently the futures in the US pointing to gains of currently around 7 points. Okay, let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. Elon Musk has offloaded $5 billion worth of Tesla stock just days after holding a Twitter poll on his stake in the company. The car maker's CEO, the world's richest person, has so far disposed of more than 4.5 million shares, his first sales in more than 5 years. The regulatory filings shed no light on whether he'll keep on selling to meet the 10% proposed in the poll. Rivian shares soared as much as 53% in its US trading debut before giving up some of that gain. The EV maker's market value briefly topped $100 billion, putting it on par with General Motors and making it worth more than Ford. It's the biggest listing in the world so far this year.
We spent years and years putting this together, and really what's so exciting is seeing such a diverse group of people with diverse backgrounds and interests really coming together to create these products, and you know, standing there today looking out at the team as we rang the bell, it was quite emotional. You know, seeing so many passionate faces, it was really powerful.
That's the Bloomberg Business Flash. Tom, Francine.
Okay, Laura Wright here in London. Thank you very much indeed, Francine.
About to have my espresso, Tom. This is what happens on a Thursday morning, and there's U.S. consumer prices rising last month at the fastest annual pace since the 1990s. Well, actually, since 1990, eroding spending power for consumers and putting pressure on President Biden. Now, here are some key market players and how they've been reacting on Bloomberg TV.
A wide range of expectations for core CPI and headline CPI, and what we got was incredibly strong.
Inflation is going to be getting worse before it gets better.
We think the inflation pressures, John, have gotten broader and broader, probably continue for a while. And again, thinking about trying to call that turn, it's extremely difficult.
The next 3 to 6 months, we're going to see continued pressure.
Supply chain and airports are probably the biggest place that we're seeing cost pressure, right? And of course, fuel prices.
We're now in the perfect environment for sustained inflation for at least 2 more quarters, if not 4 to 6.
Is this going to change the Fed's course in terms of taper? No.
We still think the market's priced in, for instance, too much tightening by the Fed over the next, call it 12 to 18 months. I would fade that a bit.
Powell is not ready to do something about it.
Well, joining us now to talk inflation and the impact on equities is Emmanuel Coe. He's Barclays Head of European Equity Strategy. Emmanuel, thank you so much for coming on and coming in the studio. When you look at that inflation print, so now there's markets, repricing a lot of Fed expectations. We're certainly thinking this is not as transitory as it could have been. What does it mean for equities?
Well, good morning. I mean, I think the equity market is probably the best hedge against inflation, right? So in the last couple of weeks, we had a lot of tension in the bond market. And the bond market is somewhat dependent on central banks. The equity market has something else to absorb or to shrug off the bond volatility, and that's earnings, right? And in the last couple of weeks, we had very strong earnings reporting season, very strong earnings rebound, and that's been allowing the equity market to manage and to shrug off this inflation pressure. Businesses have pricing power, and this is what we found out with the Q3 reporting season, and this is why they can so far survive in the backdrop of higher inflation.
But Emmanuel, does anything in this inflationary data that we've seen suggest that the defense of those margins is going to be challenged in the months ahead for these corporates?
Well, clearly, we are seeing more and more businesses talking about higher cost, supply chain not getting better. So this is something which is adding pressure on margins. But again, demand is very strong. And to us, one of the key takeaways from the reporting season is confidence from businesses in demand sustainability, right? So on a 6 to 12 month horizon, we do think the inflation outcome is very dependent on what will happen with COVID. If COVID situation globally, in particular in East Asia, improves, we should see some of the supply bottlenecks easing, and we should see some of the production cost easing as well, which will, at some point, provide some support to margins.
I mean, I guess, Emmanuel, the question, and this is something that we've been talking about quite a lot, is that it's quite difficult to, say how much of it is COVID and how much of it is quirkier supply chains that actually, is also part of the transition of the economy. But if you go back to inflation, are we not going to have a taper tantrum?
Well, so far we had very careful communication by central banks. And I think the Fed has been spending a lot of time.
The BOE.
And well, we clearly have an issue about communication, right? So clearly the sticky inflation will force central banks to fine-tune communication. And indeed, the BOE last week surprised the market and realized that, well, if you provide something but don't deliver, you might be in trouble, right? So clearly, I think the stickiness of inflation will force central banks to adapt communication. They are very data dependent. So the market will keep speculating or worrying about the policy mistakes. So they will have to be very diligent trying to convince the market they can look through inflation and they have good reason to believe inflation is transitory. But for now, we've seen central banks sticking to the plan, which is to stay patient, to err on the side of caution, and not to overreact to a short-term inflation spike.
What do you think is the impact on the consumer as the inflationary story moves from the back pages to the front pages? And is there a concern? Do you need to start repositioning away from companies and sectors that are dependent on that very strong consumer demand that may now be under pressure as a result of these very high prices?
Well, we do find the consumer or the driver of consumer spending very well oriented. So yes, you have higher inflation. You have a very strong labor market. You have very high asset prices. You have very cheap financing condition. You have a very expansionary budget, and government will keep spending to support growth into next year. So on balance, we feel good about the private sector and the consumer in particular to be in a position to absorb some inflation. But of course, the question is whether you will see second-order effects through the wage spiral, right? Are you going to see at some point wage inflation picking up, which could be a red flag for central banks? We don't find much evidence of that yet, but that's something we are monitoring very carefully.
Yeah, that seems to be a consensus view that so far we haven't seen that stickiness in wages in terms of that demand, but certainly people are watching that very closely. Yeah. Emmanuel's going to stay with us. Great to have you in the studio. Emmanuel Coe, of course, Barclays Head of European Equity Strategy, will be back. We'll get some of his calls on where you want to be exposed in this high inflationary environment. Let's check in on some of the individual stocks then on the move at the open. We touched on this with Anna before the break. The luxury goods maker, of course, the London-based fashion company, Burberry coming out with results that missed estimates in terms of the first half, but they did say that they are seeing strong growth still in China, obviously an absolutely crucial market for this company. But look at that, the shares down more than 8%, 162 points. So pressure on Burberry, not convinced by that line that we heard in terms of the strong growth out of China. They did restart their share buyback and they have maintained their guidance. ArcelorMittal, of course, benefiting from the higher prices, but they did struggle in terms of deliveries, particularly to the auto sector. They also warned, by the way, on the outlook for China, given the pressure on the real estate sector there. Nonetheless, investors rewarding that company, at least in the first few minutes of the trading session here, gaining around 2%. Daimler as well, we had the news that they're selling their stake in Renault, the entirety of their stake, unpicking then that three-way equity tie-up between Daimler, Renault and Nissan, currently down 0.3%. And pressure there on Renault, of course, which has seen Daimler selling down its stake. About $364 million, the value of that stake, down almost 4%. Francine.
Coming up, climate talks heat up while China and the U.S. vow to work together to cool down the planet in a surprise joint statement. We'll speak to the Chief Financial Officer of RWE and the Chief Executive of Xilinx this hour. This is Bloomberg. Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know what the challenge is with getting people back into the workforce.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open, everyone. We're about 12 minutes into the European trading day, and actually we're not seeing that many losses after the sell-off that we saw in the US yesterday because of that CPI data. If you look at what's happening in Europe overall, look, they're actually holding strong after some of the equities in China gained amid speculation that officials will seek to ease the cash crunch at property developers. So that's a positive. Of course, there's a lot of worry about the fastest U.S. inflation print in 3 decades that sparked this Wall Street slide, but it doesn't seem to be filtering through to these European stocks. Now, on to some of the equities we're watching, and we're back with Emmanuel Coe, Barclays head of European equity strategy. Emmanuel, we talked a lot, about the bigger picture, about the support that we got through some of the earnings overall. If you look at the luxury sector, and Burberry is case in point today, how much are they suffering from what's going on in China? And does it make a difference whether you're more exposed to the U.S. longer term, or will everyone eventually have to be exposed to China?
Sure. I mean, China has been a big source of concern for market all year, right? So the Chinese market down 25%, Chinese credit spreads are tight or highest ever. There was not much impact on the broader market in US and Europe, but obviously some stocks exposed to China have been hurt. And, we had this summer sell-off in luxury goods, but the results from LVMH in particular and some other players managed to reassure the market about the resiliency of the consumer and the middle class. So we had a very nice rebound in luxury shares in the last 2 months. Now, Burberry today numbers are kind of mixed, but I would say for us the story is very much about consumer still being the key story in China. We do think that what the government is trying to do is to transition the economy from investment to consumer, to make growth more sustainable, more balanced. And, to some extent, we've been hearing in the last couple of days, as you said, Francine, some talk about, credit growth stabilizing, mortgage support coming back or easing. And that's something which could somewhat support sentiment on the housing market, which is a key driver of the consumer. So we feel fairly good about consumer in China into next year. We are still more cautious on the more, infra, commodity-driven part of the Chinese market. We think China will not overstimulate their economy, and we think China will not grow their economy in a very capital, commodity-intensive way anymore.
In terms of what you're looking at here in Europe, the focus, particularly on the cyclical sector, amid an economic recovery that some are questioning just how long that's going to be sustained for. What is your preference for getting exposure to what is still a recovery, even if it is maturing where we are in the cycle?
Yeah, so the growth is slowing, but should stay above trend. And in this backdrop, you want to be exposed to a sector which can grow their earnings and somewhat defend their valuation in the backdrop of higher rate volatility. So we like banks, we like financials, we like energy, we like luxury goods, we like autos, we like reopening, leisure, some of the transportation stocks.
It's not fully priced into those sectors at this point?
Well, obviously something is priced in, but we do feel there is some upside left with earnings likely to beat estimate into next year. And again, we don't find their valuation overly stretched.
Emmanuel, thank you so much, as always, for speaking to us. Emmanuel Coe, Barclays head of European equity strategy. Now let's get straight to the Bloomberg Business Flash. Here's Laura White. Hi, Laura.
Hi, Francine. Germany's Siemens says it expects profit margins to increase across its three main divisions next year. That's as the industrial giant reaps the benefits of a multi-year streaming program. The group reported net income of 6.7 billion euros for the full year, beating a consensus estimate for 5.7 billion euros. But the company warned on pressures from component shortages and higher raw material prices in the coming months. The EU is set to prolong a temporary waiver across its banks and money managers to continue to clear trades in the UK. Officials have decided the waiver, which expires in June, was just too short. They'll give details of the extension early next year. General Electric is offering to buy back up to $23 billion of bonds in one of the largest corporate debt buybacks ever. It's targeting a series of bonds maturing through to 2050. The company is on track to cut $75 billion of debt, boosting cash flow and profit margins as part of a massive restructure program. That's the Bloomberg Business Flash. Francine, Tom.
Laura, thank you very much indeed. Okay, joining us now is Ven Ram from our Markets Live team. Ven, thank you. Good to get you on set as ever. Talk to us about the Treasury sell-off that we saw yesterday, whether you expect it to be sustained and how we should be layering the inflationary data on top of this.
Well, Tom, I don't think we should expect it to be sustained simply because there were too many factors weighing in on the Treasury sell-off yesterday. Obviously, we had the headline inflation print, which was above anyone's expectations. But we also had an auction that didn't go very well. The tail on the 30-year auction was the ugliest in a decade. And if you saw the sell-off, it was all over the place. The yield curve was all over the place. It wasn't. So I don't think it's a sustainable thing. And if you look at the stock market reaction, it was, okay, we fell on the S&P, but it was less than 1%. So all in, I think that, when the markets come back tomorrow and take a fresh look, I think that we are not going to see a sustained sell-off at the long end. The front end is a different story. I do think that we are going to get some curve flattening into next year as the Fed starts to raise rates.
But then and we actually had an interview with Jeremy Grantham, the guru in markets, and he says the problem is that the market are so, attached to what the Fed is saying, and they've been, that belief has been so unshakable that it's going to be difficult to have any sort of repricing. Is this a dangerous loop?
I'm not too sure I agree with them entirely, because if you look at the money market pricing, the markets are already pricing more than one rate hike for next year. So, and that's different to the Fed's dot plot. So I don't think the markets are kind of taking the Fed at face value here. And I think that as we get into next year, I think that the markets are likely to be much more aggressive in pricing rate hikes. And therefore, I think that the Fed is behind the curve. And I think that they will have a lot of catch up to do. And that has implications for the front end, as I just mentioned.
Is the BOE also behind the curve as we look to next month's decision, as we take into account the data we got out today?
I don't know if they're behind the curve, but they certainly surprised the markets last week. I think that having said that, I think that they will be one of the first major central banks to start raising rates. And whether it's February or December, we don't know yet. And we'll see what the data leads the BOE to do. But I think that the money markets are pricing like 100 basis points of tightening by the end of next year, which I think is a bit too aggressive. I don't think the BOE is going to be raising rates by 100 basis points in the next 1 year. I don't think so at all.
Okay, Ven, thank you so much. Ven Ram there from our Markets Live team looking at treasuries and a lot of these asset classes. Now, coming up, Elon Musk sells more Tesla shares. The world's richest man has now collected more than $5 billion in just days. Will he continue to sell off stock? That's $1 million question. We'll talk about that and Rivian next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Welcome back to the Open. We are 23 minutes into the European trading day. You're flat across the benchmark Europe Stocks 600. Gains of 0.3% here in the UK on the FTSE 100. And you're seeing just very modest losses on the DAX over in Germany. Sector by sector, basic resources at the top of the list, travel and leisure at the bottom. One corporate that we are focused on the back of these earnings, and also a warning about China, is Burberry, dropping more than 8%, 8.4% then. The fashion goods maker, of course, based in the UK, suggesting that the COVID restrictions that China has put in place really did have an impact on sales, which missed estimates. Longer term, they still see there's resilience in China, but nonetheless, investors taking this pretty badly so far, Francine.
Yeah, and it was interesting. I think we had a great BI piece looking at what are some things that we should be watching out for, and it seems that investors were also frustrated by the chief executive's focus on cost cutting and actually trying to get that under control, and they would have preferred strong top-line growth in order to be a little bit more excited about this recovery story. This also comes as the chief executive is leaving, I think, in a couple of weeks, and he'll be replaced by a new one. So we could see a bit of turbulence at Burberry. Onto Elon Musk, the world's richest man, has just sold an additional $5 billion worth of Tesla shares. That's on top of the previously reported $1.1 billion worth that he liquidated to cover tax obligations. Now, Bloomberg's Craig Trudell covers the global car industry. It feels like he covers, Elon Musk 99% of the time right now. I mean, it's amazing to watch, actually. It's a fun story. He tweeted he'd sell 10%, and then yesterday he sold quite a lot of stock, $5 billion, for the first time in 5 years.
That's right. And some of this, interestingly, was pre-planned. I think a lot of people are sort of zeroing in on that rightfully and saying, well, wait a minute, he took this poll, and so was this poll just a stunt? I think Elon is sort of maybe the only person who knows the answer to that question. Technically, he could have canceled or called off that plan. But this was a big chunk of shares that were sold. There also may still be more to come because we have not reached the threshold yet where he's sold enough to get to that roughly 10% figure. But I think one of the other things that's interesting here is that, this is maybe not just a matter of, the controversy over billionaires and the unrealized gains that they've gotten from the value of their stock holdings going up. This is also about, options on the part of Elon's part. Some options he got a few years back that were going to expire. He needed to sell those. So a little asterisk to that Twitter poll, or maybe two of them from this weekend.
Yeah, so those were baked in, and he has quite a lot of jurisdiction to kind of move the dates around the selling. Correct. Do we have any clarity on if we have more option sales or more stake sales coming from Musk at this point? Do we have any sense if that's going to happen?
So I believe it's about 4.5 million shares that we know of at this point. He would have to get to about 17 million in order to get to that 10% figure that he floated in the poll. So this may go on for a few days before all is said and done.
All right, Craig, you have to come back to talk about Rivian. I mean, it was an amazing day, wasn't it, for Rivian? Like $88 billion valuation?
Yeah, maybe one of the most valuable automakers in the world now, despite just a handful of sales at this point.
Yeah, so we want to hear more about that. Craig Trudell will join us. Our overall he spearheads all of our car coverage globally. Now, coming up, Germany's RWE reports, we speak to the CFO of the energy giant. That's coming up next. It's, of course, something about renewables, but also fossil fuel. This is Bloomberg.
Проходим опасный участок, ответственный. Там поднимаете, нажимали. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца как бы внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. The hottest U.S. CPI print in 30 years weighs on risk appetite as more voices warn inflation is not transitory. The S&P 500 falls a month in a month. Climate talks heat up. China and the U.S. vowed to work together to cool down the planet in a surprise joint statement. We'll speak to the CFO of RWE and the CEO of X-Links shortly. And Elon Musk cashes in, the world's richest man, unloads $5 billion of stock in Tesla after his Twitter poll creates a firestorm. Now, if you look at the markets, Tom, of course, a lot of focus on inflation, some of the earnings, and then luxury with Burberry in focus.
Yeah, Burberry really taking a hit on their concerns about what's happening in China, the restrictions there. Emmanuel Cole, though, saying and telling us from Barclays earlier that you can look through and past these inflationary concerns, and he's seeing earnings per share, the team there at Barclays, EPS of around 14% for European stocks next year. Back to fundamentals, that is his argument, and that will continue to propel equities higher into next year. That is the line from Barclays, at least. The Europe Stock 600 is flat at this stage, but the breakdown is clear. You're seeing gains of 0.3% on the FTSE 100, despite the pressure on Burberry as a result of those China concerns. The sales for that luxury company missing the estimates. The CAC 40 is gaining 11 points, 0.2% almost. The DAX is flat. Let's break it down and see how things are playing out on a sector-by-sector basis. It's worth pointing out the iron ore has jumped again. This is on the back of some reporting suggesting that possibly officials in China are going to ease conditions around the real estate sector. We also had the optimism coming through from the fact that, at least for now, Evergrande has once again avoided a default. And that has led to Basic Resources on the back of iron ore gaining almost 2%, top of the list in terms of the sectors. At the bottom, you're seeing losses for travel and leisure down more than 1%. Retail is also lower by about 1%. Burberry will factor in to that. That is the sector-by-sector breakdown then, about 30 minutes into your trading session here. Also worth mentioning that the data out of the UK on a monthly basis, at least, was more positive than the estimates. GDP of 0.6%, even on a quarterly basis, a bit of a miss. Fran.
Now, China and the U.S., Tom, are promising to work together to slow global warming in a surprise joint statement issued yesterday. Now, it does inject a new momentum in the last days of global climate negotiations at COP26 in Glasgow. Bloomberg's Emma Ross-Thomas runs our coverage of COP26. She joins us now on the phone from Glasgow. Emma, so this seems like a big deal, but at the same time, China did not sign up to the methane pledge.
Yeah, that's right. I think this probably will become one of the sort of top three achievements of COP, probably. I mean, you'll remember that before the Paris Agreement in 2015, the US-China deal was really what sort of opened the way for that landmark agreement. And I think that's one of the reasons that people are so excited about this agreement. So the key thing here is they're going to talk about action in the 2020s. The 2020s is meant to be the sort of crucial decade, because if we don't manage to, step up the action this decade, then basically it's going to be too late. The thing to note, though, is that not only did Kerry, as you mentioned, China didn't sign up to the methane pledge. They said they're going to go their own way. And also Kerry said that he didn't manage to convince them to bring forward their date for peak emissions. He said something like, we peaked out, talking about peak. So I think, that was something that the US has been pushing for China to bring forward its 2030 peak date. But overall, it's positive. It probably will, as you say, inject a bit of extra momentum into the overall discussions. Although, of course, China was not the only obstacle. So, we're going to have to see how that plays out with other countries as well. We had Boris Johnson yesterday urging countries not to stand in the way of the historic deal. So, we still have to see how the broader deal is affected by this. And then, of course, next week we've got this Biden-Xi summit, and Kerry did say yesterday that this might pave the way for a broader sort of improvement in relations. So we'll have to see.
Okay, Emma Ross Thomas on the ground, busy as ever in Glasgow. Still more work to be done, of course, in terms of COP26, but that surprise announcement by Beijing and Washington. Let's switch focus to the corporate impacts then, how these companies are wrestling with COP26, climate, the crisis, of course, and energy prices. Profits at RWE rose, I should say, in the first 9 months of this year as Germany's biggest power producer ramped up generation at its coal plants. The company also saw gains from the extreme price swings in energy markets, with earnings at its trading division jumping 53% in the period. We're joined now by RWE CFO Michael Muller. So thank you for joining us this morning to go through these results and get your views on the energy transition. So a decent set of numbers for the trading unit, and then benefiting from additional coal production and the burning of coal, I should say, in terms of power generation. Does that continue, do you think? And how do you square that with your commitments around climate?
I think we first need to discuss how fundamentally energy markets are working. I think that's also important to understand going forward. I mean, in the end, the energy demand needs to be met by supply. And what we currently see is that, especially because of high gas prices, lignite and coal generation suddenly comes back into the money, even though CO2 prices are really high. And that really indicates that the only way to decarbonize our world is to extend the build-out of renewables. Because by the moment we have more renewables, coal production will automatically fall out of production. So therefore, I think the direction also discussed in Glasgow is the right one. How do you really speed up targets, and then also how do you speed up the build-out of renewables? Because that's the only way how to really get the decarbonization running.
Right, but at the same time, Mr. Muller, I think we have to accelerate maybe some of our efforts. Certainly, this is what a lot of the protesters say. Winter's coming. It's difficult energy-wise. Will RWE continue to actually fire up coal?
Well, I think in the end, in the short-term optimization, it's always a supply and demand. And I mean, look at Germany. Last year, when gas prices were low, there was very little lignite generation. And this year, even though CO2 prices are much higher than last year, we have more lignite production. So it's not that we want to produce it, it's more a question of energy balances.
Of course, Mr. Muller, but as you see it going into the winter, will you have to burn more coal?
Well, naturally, in winter, energy demand will increase, and that will also lead to additional generation. So yes, clearly, compared to summer, there will be more generation.
Okay, there is, of course, the demand factor. That is essential. You pointed to that, and that remains very solid as we negotiate and navigate these winds, these turmoils around that demand for energy. But there is also the optionality as a corporate leader. And at this point and this moment in time, as COP26 is continuing, RWE is involved in digging up coal mines in a part of Germany called Lützerath, the Garzweiler coal mine. Why are you continuing that so you can invest that money in renewables?
Well, I think you have to look at our strategy, and we'll have a capital markets day on Monday. And our strategy is clearly focused on the build-off of renewables. I mean, if you look at the current year, we really made great progresses. So we took online new assets. We invested more than 2.5 billion into renewables, and we also took just in the last quarter investment decisions for 500 megawatts of additional renewables. And that brings us clearly in line with our target of more than 13 gigawatts of renewables generation by 2022. So the company is really set to grow, and we'll also give more flavor to that topic in our Capital Markets Day on Monday. So we are clearly in line with that strategy, and we are fully committed to grow renewables and by that contribute to the energy transition.
But Mr. Mueller, what about your lignite plans? So you're getting so much pressure from shareholders to actually be more green, and I understand that you are doing a huge efforts on renewables, but could you actually pull away from lignite maybe earlier than planned?
Well, I think the discussion we're having with our investors is, in the end, it's important that you really speed up the transition. So you should measure us on the speed of transition and also on if we are really delivering against our commitments. And if you look at RWE, we were the first one in the German hard coal auction to bid and then to decommission our hard coal fire plants. We decommissioned our hard coal fire plants in the UK, and we converted them in the Netherlands into biomass. And also looking at lignite, we are also already now reducing the number of assets we have in lignite. So we are clearly on that pathway. But at the same time, you also have to consider that we want to make that transformation in a socially responsible manner. So we have to look into the regions, we have to look into the energy supply and energy security, and we also have to look at our people to restructure them, as I said, in a socially responsible manner. So what investors discuss with us is really, is that the maximum speed we're taking? And that's indeed the fact.
You're continuing to invest in gas. Do you see the Russians increasing supplies?
Well, I mean, what you've seen this year is that the Russians actually produced more gas than last year. It's only the direction where the gas has gone. I mean, as in Germany and in Europe, we had a very cold winter, so gas storage were pretty much depleted. And what we saw in Russia is that the Russians obviously first filled their own storages in the country, and they also exported this year much more gas into Turkey and into Asia. So in the balance, Russia is actually producing more gas, but it's just less coming to Europe.
So, Mr. Mueller, overall, how are you expecting gas demand in Europe to evolve in the next couple of months? How much more will we need of gas?
I mean, in the end, it's always a question of weather. I mean, our whole energy system will be much more dependent on weather. So if it's a cold winter and we have little wind, then of course the demand will strongly increase. On the other hand, it may well be that winter becomes warm and we get lots of wind, then the balance will clearly ease.
Okay, so RWE's CFO. That demand, of course, watching the weather patterns, there is some data that suggests that it was going to be particularly cold November. So if that's the case, then you would expect presumably demand for gas to continue to be elevated. RWE's CFO, Michael Mueller, joining us for a breakdown of the results and that energy transition. Thank you. Okay, coming up, we're going to stick with energy. Xlink CEO David Morish on Europe's energy crisis and a project to build the world's longest undersea power link from the UK to Morocco, or from Morocco, in fact, to the UK. That interview is next. This is Bloomberg.
Common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Britain is suffering from a power crunch. The country relies on other European nations for about 8% of its supply through undersea cables. Prices have been surging, and that's before the usual winter season pressures. What's the problem? Here are a few. First, demand has surged as Britain emerged from the pandemic. There's a natural gas shortage across Europe, pushing up power prices. Making matters worse, the UK doesn't have as much gas in storage from Russia, the world's top exporter, as it usually holds at this time of year. Next, too little wind and solar power. Finally, one of two electricity cables to France was damaged by a fire in September and won't be back to full strength until October 2023. In response, some UK utilities have been forced to use coal-burning plants, despite the push for more green energy. With all this, UK power prices hit records in September, and while costs have come down, they're still far higher than the average over the past 5 years. According to analysts, consumer electricity bills could jump by 30%. There could even be blackouts. So the UK economy could be facing dark times ahead.
A look there at the energy crunch facing the United Kingdom from Bloomberg's Anna Edwards. Now, our next guest has big ambitions to boost the UK's renewable energy supply and help tackle the country's power crunch. Xilinx plans to harness Morocco's vast renewable energy potential and feed it to the UK via the world's longest power link undersea cable. Now, we're joined by Xilinx Chief Executive Officer Simon Moorish. Now, Simon, thank you so much for joining us. This is, basically building a cable to get some of the solar and wind power from Morocco to the UK. It's an exciting project. It just all depends on whether Morocco is on board. How are discussions with the government going?
Discussions with the Moroccan government are very, very positive. So they've been a great partner on this. We have all the land secured. We have the export license all done, and Morocco has enormous ambitions to be a green electricity exporter to Northern Europe on there, and really a sort of powerhouse on there. Okay. So certainly from a Moroccan end, we are in an incredibly good position.
Okay, that's the Moroccan end. And you have kind of a nod to this. What about the UK end? How are your conversations with the British government going? How supportive are they, and what do you need to see from them?
Okay, so we have further to go on the British end. So I think we've had some positive engagement from both BEIS and Treasury on that. And BEIS is obviously the business, energy, industrial strategy part of government. What we are asking them for is a contract for difference of £48 per megawatt hour. Mm-hmm. So this is for firm baseload power because of what we're being generating in Morocco with the battery storage, and that is in comparison to £92.50 that they have recently given to Hinkley for nuclear power. Right. So that's effectively what we're asking the UK government. This is a free option for them. because this is well below their own analysis in terms of what market prices would be.
If they don't give you the support, would you do it anyway?
So we fundamentally believe that this is absolutely necessary, because whilst the UK is pushing out its wind ambitions, and frankly, offshore wind is an incredible resource and costs keep coming down, one of the problems it has is when the wind doesn't blow for several weeks in a trot, then actually you've got a big issue for the UK. And we've seen that in April this year, we've seen it much more recently in September and August, and short-term battery storage doesn't solve that. So you need to have some form of base load power to be able to provide the UK. And with nuclear, many of the nuclear power plants coming offline over the next 10 years, many of the gas plants coming offline, actually, we haven't got any other solutions.
Yeah, the importance of the energy mix, absolutely. But in terms of, and it sounds like that was a no, that you wouldn't go ahead without that government support, but you can clarify if that's not the case. Where are you in terms of those discussions around the contract for difference and £48? Are you close to getting them to agree to that? And if not, when do you expect that to happen?
I would hope and expect that we will have some very positive responses out of government within the next 12 months. Okay. Now, this is not slowing us down at this moment in time, because there's actually a huge amount to do. One of the key constraints on this is actually the cable. Yeah. So if you think about the length of cable that we need, so the electricity industry is moving much more from moving electricity from AC, alternating current, to DC. It's a much more efficient way of transmitting power. All the interlinks, the most recent link between the UK and Norway, which just went live, I think it was 1st of October, and that has been a huge booster to UK power on there, and reducing prices. So effectively, we need to be building the cable factories for this, because there's simply not enough power.
If it goes ahead, I mean, there's a lot of believers that this will go ahead. A lot of supporters saying this is a great idea. A lot of people saying, look, it's going to be very difficult to push this through.
I don't believe so. So we're already going full steam ahead on the cable factories. Yep. So the three European producers of HVDC cable, they have between 4 and 6 year order backlogs. And Goldman Sachs predict that demand for this cable will grow 9-fold in the next 10 years. So you've got an enormous demand imbalance, and that's without projects like Xlinks, Sun Cable, and other projects which are really looking to transmit power longer distances. So I'm very, very confident that this will all be going ahead, because actually, what are your other solutions?
Water.
What?
Water. In the UK, can you not use water to I mean, it's an island.
You're talking about tidal
renewables, and hydrogen.
Oh, so hydrogen is absolutely an important part of the decarbonisation energy mix. Yeah. But it doesn't solve the electricity supply, because it's so expensive. If you think about how what you're doing with hydrogen, you're using electrolysis. Right. You're then compressing it. You're storing it. You're transporting it, and then back through a fuel cell. The round-trip efficiency is less than 40% on that. So actually, Xlink's product is so much more efficient, and we would be half the cost of hydrogen doing this.
Okay, Simon, we wish you luck. Thank you very much indeed for coming on. That is Simon Morrish, the CEO of Xlinks. Okay, coming up, we focus in on the UK after a busy day for data. What are the implications for the Bank of England ahead of that meeting next month? This is Bloomberg.
Kong lost its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the Open. We are 54 minutes into the European trading day. Flat across your benchmark, but you're seeing some upside for the UK. The FTSE 100 is getting 0.4%. The DAX over in Germany down 0.1%. The futures in the US pointing up by 0.2 after the sell-off yesterday. In terms of sectors, basic resources here in Europe gaining almost 2%. Travel and leisure at the bottom of the pile, down by more than 1%. Let's focus in on the UK now, and the economy growing more than expected in September after a surge in services and construction. Let's bring in Bloomberg's UK economy reporter, Lizzie Burden. Lizzie, what is your top take from the GDP numbers that we got?
Well, they came in above expectations for the month, just a shade above, but just a shade below for the third quarter. And it's the third quarter, the quarterly numbers that the Bank of England really cares about. It really represents a slowing of momentum after that rapid rebound over the summer. And remember, it was the risk of choking off the economic recovery that put the Bank of England off hiking rates at its November decision last week. So these numbers are really not far off the Bank of England's updated predictions. They'll probably buttress market expectations that the bank will hike rates soon, if not next week, and it puts the spotlight on the jobs and inflation data next week.
Yeah, so all eyes on manufacturing, not as strong as it could have been, and also cars just are missing the chips.
And that comes back to the supply issues that we were talking about yesterday. You had other supply issues over the summer. Remember, you had the pingdemic that meant that workers couldn't go in because they'd been notified of coming into contact with a positive case of coronavirus. All that is what held up the recovery over the summer.
Are there political costs for Boris Johnson and team at this point?
Well, you've got a political moment right now because of the cost of living crisis pushed up by inflation, but also these sleaze allegations that keep coming out in the UK. They've divided the ruling Conservative Party, dented them in the polls. This is after last week you had the government U-turning on an attempt to overhaul parliamentary standards when it tried to save a former minister from suspension. But unlike the cost of living crisis, you can't blame this one on the pandemic. And so it's an open goal for the opposition.
Thank you so much, Lizzie Burthen, with the very latest on the UK economy. Now, that's it for the European Market Opens. Surveillance Early Edition is up next, and we'll look at the markets. I mean, it was quite interesting to see that U.S. inflation report. It kind of repriced a lot of the treasuries. So far in Europe, brushing off those concerns. Flat, but no heavy selling, despite the fact that you've got inflationary pressures at their highest levels across 3 major economies for at least 30 years. Plenty more ahead. This is Bloomberg.
morning, traders. How are you doing today? I'm going to place an order to sell short euro at 114.73.8. You got the strategy, you know what to do. Please place your order at 114.73.8. Okay, stay with me. We'll close this trade in profit. Okay, also, as you can see, we need to place another order to hedge, you can say like that, euro, because we have two long positions on euro as well. Okay, guys, stay safe and I'll speak to you later.
We founded the company in engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time?
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
As you can see, it moved lower quite substantially, so please cancel this order. Okay, and let's see, let's wait what's going to happen next with euro. If it will change, maybe momentum will change and we'll place order to buy it. You never know. We need to see what our indicator, strategy indicator will tell us. Okay.
Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and this is what's coming up on today's program. The hottest U.S. CPI print in 30 years weighs on risk appetite. More voices warn that inflation is just not transitory. UK economic growth slows in the third quarter. The GDP figure came in a little bit weaker than the latest Bank of England forecast. And Elon Musk sells additional Tesla shares. He's now collected more than $5 billion in just days. Now, first thing is first, let's check in on the markets. Again, a lot of things that are weighing on investors' minds is, of course, that inflation print in the U.S., the highest since 1990. But the focus is not actually hurting some of the prospects for stocks. Part of that has been internalized. We did see a movement in Treasury, but that also stabilized overall. The European stocks 600, you can see unchanged. Some of the focus, for example, is on luxury. Burberry down after there were questions about their productivity or actually their exposure to China because China's buying less luxury goods from Burberry. The S&P 500 futures also slightly up, but again, nothing huge. And if you look at, I'm not sure what we're looking at here. We may get you a yield so that we have exactly what we see in terms of the 10-year yield, a better way of looking at some of the treasuries. And then you can see pound 133.87. Now, this is a picture overall for the markets in Europe, but you can see the CAC 40 gaining some 0.2%. Again, this is a market that's subdued, trying to figure out some of the earnings, the energy concern, and of course, what we're seeing with inflation. We don't have the same inflationary pressures, certainly not when it comes to wage growth in Europe that we have in the UK and the US. Now, US inflation jumps most in 30 years. The latest CPI print came in at 6.2% year over year. The last time we saw inflation this high was back in 1990. The Fed Chair Jay Powell said this month that officials could be patient on raising interest rates after announcing a start to reducing their bond purchases. Now, the co-founder of asset management firm GMO, Jeremy Grantham, weighed in.
This time, the faith in the Fed is so complete that when they say it's temporary, we believe it. The Fed, in my opinion, hasn't done a thing right since Paul Volcker, who was brilliant. All of the others have encouraged a chain series of really dangerous asset bubbles.
Now, the San Francisco Fed President, Mary Daly, said she's monitoring eye-popping inflation, but still sees us at transitory.
Inflation is higher. It's eye-popping. This is a transitory period. That's what we believe. That's what I think when I look out at the data, but it's directly related to COVID. And as quicker we get through COVID, the better off we're going to be as an economy.
Let's bring in Bloomberg's chief Asia economics correspondent, Enda Curran. So, Enda, exactly what are we seeing and what does it mean for the future?
Well, I think it's obviously looking to be more broad-based, more persistent than anticipated. Francine, it seems to be across a spectrum of the economy, from energy through to the costs for vehicles, through to living costs or shelter costs. And I think it does now raise questions about where the Fed goes from here. We know that under Chairman Powell, they've been somewhat patient when it comes to, signaling when they might raise interest rates. But this might change that dynamic now. And of course, that will have implications for central banks in emerging economies around the world too. The other part of this story to consider is what it means in terms of the political backdrop for the Fed. If Chairman Powell's under pressure to raise interest rates at a time when his job is up for grabs and the White House are considering an alternative candidate, possibly Lael Brainerd, that brings into question what a change of governor or not would mean for U.S. economic policy. So right here, right now, I think there is a lot of focus on the supply chain story and how that irons out in the months ahead, but you'd have to say that the inflation story looks to be more acute than most people anticipated earlier this year, and that will continue to pressure the Fed when it comes to their policy outlook.
Enda, thank you so much. Bloomberg's chief Asia economics correspondent, Enda Curran, looking at inflation. Now we're joined by Lucy Baldwin, Global Head of Research and Equity Advisory at Citi. Lucy, thank you so much for joining us. I mean, it was a big day for inflation. The markets moved and the data certainly put pressure on a lot of the markets, but also it wasn't a taper tantrum. It wasn't the end of the world. So are they believing the Fed, or is a Fed move actually already priced in?
Good morning. Absolutely key questions. You're absolutely right. The ongoing inflation debate reigns large, and the transitory versus persistent is obviously still somewhat out there. Our view, for example, is aspects of this are still a little transitory, albeit we do think the Fed are going to have to take action. So our view at Citi is that we're going to see 3 hikes next year between June and December. So that's more than the market is pricing in. And that's exactly because of the things you're saying here around needing to get control of different inflationary spikes, such as labour, because of the risks to that price spiral. I think the markets at the moment are trying to weigh up what this really means, right? So you've got some differences across different markets, but certainly the equity market, our view is there is still probably some upside into the end of this year, because we think at the moment real yields haven't actually moved up. A lot of the action's been at the front end so far, hence a relatively sanguine reaction so far.
Lucy, when you look at wage pressure, and it really all boils down to how much wage growth we'll see. In the U.S., I think it was 5.8%. Does that level out, or are you a believer that we need to see interest rate hikes because that wage pressure will continue throughout? And is this a global phenomenon?
Yeah, I think that what we've seen in the data in the U.S. particularly is that it's broadening out now. Whether it was coming through in restaurant prices, whether it was coming through in shelter, it's no longer quite so isolated. And as you say, once it gets into the labour markets, you get that reoccurring effect. And obviously this goes on top of all the other supply chain challenges and issues that we've got, which kind of interact with this and compound it. But you're also right that this is very global. We see it here in the UK. Obviously, we've just seen factory inflation in China. Again, huge prints there, quite hot. And again, all of these things together are what's so problematic. And of course, we can't forget, this is coming at a time when growth is softening. Now, clearly, those two things are somewhat related, and a lot of people are hoping that the growth piece solves itself if you can solve the inflation problems.
So you're, in terms of your market expectations, and I love having you on to talk about this today, you're definitely outside of the kind of the mainstream. I think there's about, one rate hike maybe coming from the Fed.
Yeah.
Does the market actually have a taper tantrum, or do you think the Fed will guide them through this so that it's kind of, easy as it goes?
Yeah, look, we get this question a lot, and we often get the question about emerging markets in particular, whether we see a repeat of 2013. Our view here is that, there's so much focus and debate and discussion on it. I think markets are expecting this, and clearly in terms of starting to expect what we're expecting, i.e. this sort of pull forward and this potential for it to be 2 or 3 next year. If you then look beyond that, you're obviously not seeing a huge amount priced into those then next 2 outer years in the US, which is interesting and tells us something. I think, to your point on the sort of taper tantrum more broadly, our view, for example, with emerging markets is they're in so much better health this time round than they would have been a few years ago in 2013. Currency's less overvalued, current account deficit's not in such bad shape.
So what do you do with the energy crisis? And again, this is, the impossible question to answer is where do oil prices go? And actually, are we going to see, for example, some emerging markets get left behind, because of that?
Yeah, and that's a big multifaceted question. Again, a lot of it comes back to inflation. It's interesting to see what obviously China has done to try and combat the challenges, obviously trying to, initially rein in, obviously to try and meet their green energy targets, very focused, and that's caused a lot of these problems. So I think when you look ahead to the energy crisis, I think it's going to take a while to solve some of these issues as we go through the winter. I mean, there were obviously a lot of factors that caused it, from weather, from outages, to obviously parts of the green agenda and the shift to renewables, and all those things coming through together at the same time with these other inflationary pressures and demand for goods rather than services coming out of the pandemic. So I think when you look ahead, like very long term, our view is that you will see, obviously, oil prices coming back down, but that is going to be well into next year, I think, now, before you start to see some of those pressures really easing. You've had so much supply discipline. I think oil in particular has been really a function of policy and OPEC policy rather than an underinvestment in the oil sector per se, and a lot of discipline.
Lucy, overall, where do you see the best value in equities? Is there, part of the market that's unloved, or is there something at the moment that you want to be invested in?
Yeah, look, you're absolutely right. There are still pockets that we find hugely attractive and where we see value. For example, the UK market, we still think there's some value there for sure. We have become more nervous about parts of the US market, for example, tech and the very high growth sectors on big valuation multiples. And so we had kind of eased our recommendations in certain sectors like that. We still feel fairly bullish on financials, for example, would be a place we'd tell people to look for value. And we do still see some upside in the S&P into the end of the year.
So is financials an inflation play, essentially?
Well, I think, you are going to at some point see those longer term yields start to rise. As we talked about, all the action at the moment at the front end, but I think that will obviously be, we feel, quite positive for financials. Obviously, the big caveat to all of that is that you don't see too many rate hikes causing a problem much more broadly in markets because of the fragility that we've got post, obviously, a fairly big build-up in debt in the system over recent past. So there's definitely risks and clouds forming across the equity market, Francine.
Is there anything that you do in the UK here? So we were, the market was definitely surprised last week by the Bank of England. Yes. And then today we had GDP that were a little bit short of the Bank of England's forecasts.
Yeah, look, I think the UK is a really interesting, case study at the moment, because we're obviously coming through periods of distress, whether it's through Brexit as well as COVID. And so I think the challenge for the UK market is going to be being able to deliver on some of those growth ambitions into next year. And I think, again, the Bank of England, to your point, we all expected in the markets, I think, to see that take off, and it's obviously now not happened. So we're certainly, expecting to see actually a rate hike still this year, but I think there's a lot of debate around that. But again, I think that view that they're not going to let the economy run hot for long, and that they want to try, if they can, and get grip of inflation before it causes problems down the line.
Lucy, thank you so much for coming in today. Lucy Baldwin, they're Global Head of Research and Equity Advisory at Citi. Now, we'll have plenty more, of course, on some of the corporate news as well. Tesla, the chief executive, Elon Musk, unloading some $5 billion of stock in the electric car maker. And you can see actually pre-market Tesla gaining 2.4%. They did see a little bit of a sell-off yesterday, certainly after we had that news yesterday. The stock price was yesterday it was gaining 4%. The day before it was down some 12%. So a lot of volatility with Tesla this week. Coming up, we discuss more on Tesla. That story's next, and this is Bloomberg. the energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic, and there are a handful of things going on. I think all over the world, there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now. It's a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
For the first half of the year, we are still fighting. So we are trying to get really our suppliers managed through the crisis very well, through the supply chain problems. But for the second half of the year, there's hope that there's some ease from that perspective as well.
Well, that was the Siemens Chief Executive Officer Roland Busch speaking to Bloomberg this morning. Now, Elon Musk, the world's richest man, has just sold an additional $5 billion worth of Tesla shares. That's on top of the previously reported $1.1 billion worth that he liquidated to cover tax obligations. Well, Bloomberg's Craig Trudell covers the global car industry, and he joins us now. First of all, Craig, we're obsessed with the story. The market's obsessed. Twitter's obsessed. Elon Musk is probably obsessed. So this is on the back of a poll, but we don't know whether he sold the $5 billion because of the poll where people voted for him to sell 10% of Tesla, whether this is separate.
Yeah, I think it's really difficult to parse, and probably the only person who can really speak definitively about this is Elon himself. And sometimes he's not the most reliable narrator. I think that comes across even in just how this played out, right? So we know that he had options that were going to be expiring. Yeah. He needed to cash those in, or else he was going to sort of miss the moment. But he framed this very much as being part of the debate over taxes and whether billionaires are sort of paying their fair share on the basis of unrealized gains. We now know as a result of these filings that some of the sales and transactions were actually sort of put into place back in mid-September. Yeah. So it's unclear whether or not that poll really had any bearing on that part.
Yeah, so what people really want to know is he going to sell more now to make up to 10% of the stock, or does he just ignore the Twitter poll? And it's amazing that we're talking about someone doing a poll on Twitter and then selling 10% of his massive stock in one of the most valuable car makers in the world.
I think it was Ken Griffin yesterday who said, man, that's really something. So I think a lot of people are really watching that as kind of, so why the heck would you do that? I do think it's kind of it's consistent with Musk being a sort of master messenger and, being able to kind of, control the narrative. Had he just, let these Form 4 filings dribble out, it may have, sort of sent a signal that he, was not happy about. So he wanted to kind of frame this and own this, and he's managed to do that to some extent.
Great. Do we care if what he says on Twitter is respected or not? Because it does. I don't know whether it actually has an impact on the share price longer term.
He has a lot of fans and detractors on there, and to this point, the shares have been going largely in one direction. So it's worked out for him to this point. Okay,
the other amazing story, you cover the best stories, Rivian. So this IPO'd, it's a massive valuation, and the interesting part is also it has a Saudi backer and has Amazon.
Yeah, $88 billion enterprise valuation for a company that has, only sold a handful of vehicles to this point. But as you mentioned, they have a prominent backer, a Saudi backer. They have a hugely prominent backer in Amazon. That's the one that I think is really important to the market, where you have a locked-in customer in Amazon that's going to buy its vans for years to come. And you'll also get some sort of recurring revenue from services to Amazon for those delivery vans. It's a nice racket when you're trying to get your footing as a new EV upstart.
I mean, do they even make a profit right now?
They do not.
Right?
They do not, and the outlook for them to do so is
pretty far out.
Yeah, pretty far out. We may see a repeat of Tesla here, where the market doesn't necessarily care about that and just wants to see growth.
Craig, thank you so much. As always, Craig Trudell there with some pretty amazing stories. Now, coming up, bullish comments from crypto skeptic Ken Griffin are adding to Ether's big year. We hear what he had to say next. This is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Ether is outperforming Bitcoin by a wide margin so far this year. And Ken Griffin, a noted crypto skeptic, said that the crypto space could be disrupted by Ether's underlying blockchain, Ethereum. Well, let's bring in Bloomberg's MLive Eddie van der Walt, who of course also looks at cryptocurrencies. I mean, I was pretty surprised, Eddie. I had to go back and listen to exactly what he says, because I don't know whether it means that, Ken Griffin is a crypto believer, but certainly it's just becoming much more mainstream.
It is absolutely becoming more mainstream. I mean, you're right. Ethereum is up something like 500% over the past year, whereas Bitcoin's price has doubled. So Ethereum really outperformed. Now, this is something that we do see on, in both directions, that the smaller cryptocurrencies tend to outperform Bitcoin in both directions. When Bitcoin's going up, they go up more, and same when they go down. However, Ethereum represents a different vision for cryptocurrencies. And I think this is what he's alluding to, right? I think what we're talking about is the Web 3.0. We're talking about non-fungible tokens. We're talking about all of those other things with Ethereum. Whereas Bitcoin, we're talking about money. So really, I think, yes, the people who are really bullish on the long-term growth prospects, other than Bitcoin replacing the dollar, they are getting really behind Ethereum. And I think, that it just represents a different vision.
Eddie, first of all, I mean, just on cryptocurrencies, are they becoming a hedge? Because Bitcoin touched 69,000. Are they becoming a hedge against inflation, or are we reading too much into it because of the volatility that we see, most days?
It's so hard, because immediately after that CPI reading, Bitcoin spikes higher, and by the end of the day, it's given up all of its gains. I think Bitcoin at the moment, yes, part of its narrative is, part of the sales pitch is Bitcoin is going to replace fiat currencies, and fiat currencies are devaluing, and therefore it's part of the inflation narrative. But I think it's more about the narrative than the mechanicalistic driver of inflation. When you look at the actual correlations between Bitcoin and things like CPI and break-evens, the correlations just aren't there yet. But I do think it's part of the story and it's part of the sales pitch. And I think, therefore, if we see inflation run really hot, over time, Bitcoin does well.
Eddie, what else are you looking after? I mean, if you look at some of, the forces and the confluence of things when it comes to, for example, becoming greener in that space as well, what's the likelihood of, a coin that's not Bitcoin, that's not, Ether, that's not one of the ones that we follow, becoming the top dog in a couple of years?
I think that is the risk for investors. We don't know who becomes the winner here. And as far as the green element is concerned, Ethereum is already far ahead of Bitcoin, right? Bitcoin still relies a lot on proof of work, which means burn a lot of energy to create new coins, whereas Ethereum is moving away from that model. But Bitcoin's problem is that it is reliant on these sort of quasi-religious texts that was left by Satoshi Nakamoto, which can't be changed, and that has prescribed that things have to be done a certain way. Whereas Ethereum can evolve with time as new technology becomes available, as new solutions to old problems become available. And for all of these reasons, Ethereum is more adaptable. But you're right. The risk of buying, an Ethereum now is you don't know whether you are buying AOL or Yahoo at the start of the dot-com boom. The leaders today are not necessarily going to be the winners in the long term.
Thank you so much, Eddie. I love that analogy. Eddie van der Valt there from our MLive team. Now, coming up, we'll be talking with Sir Martin Sorrell, chairman and founder of S4 Capital. We'll talk ads, we'll talk inflation, we'll also talk the metaverse and what that means for advertisers. That's coming up shortly, and this is Bloomberg.
van en contramano de lo que dicen la comunidad científica y los territorios que están en lucha. Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros. Y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Now, the hottest U.S. CPI print in 30 years weighs on risk appetite. More voices warn inflation is not transitory. UK economic growth slows in the third quarter. The GDP figure came in weaker than the latest Bank of England forecast. And Elon Musk sells additional Tesla shares. He's now collected more than $5 billion in just days. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this is what the picture's like for markets. Really, they're trading sideways. It's nothing huge that we're writing about. The focus firmly on inflation. We had a bit of GDP data out of the UK. But if you look at, stocks, even US futures, they're steady because they're trying to weigh the inflation risk, not only in the US, but overall what's happening in Europe. Chinese equities, for example, did rally on speculation that officials will seek to ease the cash crunch at the struggling property developers. Again, that's a positive for the economy as a whole. Now, let's focus a little bit on the UK. The economy grew more than expected in September after a surge in service industries and constructions. Well, let's get straight to our UK economy reporter, Lizzie Burden. So, Lizzie, overall, it was a bit of a miss, but not a huge miss.
Yeah, GDP came in above expectations for September, but just a shade below expectations for the third quarter. And it's the quarterly data that the Bank of England really cares about. It represents a slowing of momentum after that rapid rebound that we saw over the summer. And remember, it was the risk of choking off the economic recovery that put the Bank of England off hiking rates at its November meeting last week. But these numbers really aren't far off the bank's updated forecast. So they'll probably buttress market expectations of a rate hike soon, if not next month.
Thank you so much, our Lizzie Burden, their UK economy reporter. Now, we've also talked about the numbers this morning. Highest CPI inflation in the US. That's been since 1990. Back then, Germany was, well, reunified. Nothing compares to you by Sinead O'Connor was in the charts and prices were rising. I don't know if a lot of people remember it, but I certainly do. Now we've got Adele, but prices are still going higher. Well, we're joined by Sir Martin Sorrell, chairman of S4 Capital. Sir Martin, thank you for joining us. Look, we want to talk about inflation, the impact on the ads, and just in general what you're looking at for the world economy. Do inflationary, numbers mean that it's harder for your advertisers to get noticed and actually to spend more on advertising because they're worried about their supply chains?
Well, a little bit of inflation gives our clients a little bit more wiggle room, as we would put it. So they have very little pricing opportunities post probably the great financial crisis in 2008, when GDP growth was around 2 to 3% pretty consistently, and there was very little inflation. What we have now is GDP growth on the back of the fiscal and monetary stimulus during the pandemic, up at about 5 to 6% this year and 4 to 5 next year, with probably 2 to 3 in 2023. And that's when in our case, digital transformation will become, that's the other tailwind that boosts our business, digital transformation become more important. But the inflation point, when prices are being increased to cover commodity cost increases, you see with the packaged goods companies, they usually actually put more money behind advertising and promotion to enforce the price increases. So the answer, Francine, is as long as inflation doesn't get out of total control, it's probably positive for advertising and marketing spending.
So what does a rate hike actually mean for your business? Does it change much, a rate hike in the UK or in the Fed, or not really because it depends more on the real economy?
Well, our view is, and we're in Amsterdam today with our management group, first time physically together for some time, although we're continuously together online, virtually. We look at the rest of 21 as being strong. The 4 quarters continue to be strong. No really ramifications or issues from supply chain difficulties or inflation, or indeed the decisions by Apple around IDFA or Google around third-party cookies. That's been stimulative rather than dampening. So rest of 21 strong, and then 22 strong. Yeah. I think the issue for the world economy is what happens in 23. That's when the tapering that you're referring to in terms of fiscal and monetary stimulus and interest rate increases will start to bite. In our case, we've had 2 tailwinds. One is GDP growth, and the second, more importantly, is the rise of digital transformation, which in 23 and beyond will continue. The forecasts for the digital part of the industry continue to be around 15 to 20% for digital media, for marketing services, for trade budgets and digital transformation budgets. That's about a $2 trillion market, which is growing at about 15 to 20% over the next 3 or 4 years. And digital in media, in your area of the world, Francine, will be 70% by 2024.
But in terms of advertising or media spend, what industries are willing to spend right now? So you're confident about next year. What, in the more immediate term, does the holiday season bring?
Well, what we've seen actually is an escalation. You look at what Amazon is doing, for example, in terms of their big sales days. They've actually dragged them forward. I guess they're doing that partly because of their concern about the supply chain issues. But with the general backdrop in terms of GDP growth, I think consumer spending and consumer savings has been at a very high levels, and they've not been depleted as we've gone through the pandemic. What I think you will see is continued strength in consumer spending. And you referred to the Bank of England's decision in relation to third quarter GDP, and then you commented that given what we've seen even in the third quarter, the Bank of England will probably start to increase interest rates slightly. But the levels that interest rates are, I think, will not dampen consumer spending until we get, as I say, into 23, when tax increases and the corporate, personal, capital gains tax areas, wherever they come, will start to sort of dampen consumer demand.
We've seen a little bit of volatility in some of the earnings reporting. Martin, what does it mean for margins? Is there anything actually that you really want to work on S4 Capital, or will that be readjusted as the economy picks up?
Well, okay. Well, yeah, our Q3, we were up 42% like for like in terms of revenue. To date, we're at 47%. We've increased our headcount by 52%, so it's a 500 basis point difference. And that explains why we took our margin guidance down from 19% to 18% at the end of the third quarter. So what we're doing is investing in growth for the future in 22 and 23 and beyond. And that's where we see the big opportunity, the growth across all the areas in which we operate, and whether it be social and digital, e-commerce and digital. You touched on in the introduction, in our chat before the introduction on the metaverse. These are all areas, connected television, the increase in technology services, are all areas that are of great attraction to us and to our clients. And 50% of our revenue base is in technology, which will continue, of course, to be a driver. Most of the tech services companies have concentrated their client portfolios in tech in healthcare and telecommunications. And that's where the growth will continue to be as we get into 23 and beyond.
All right, Sir Martin Sorrell, thank you so much, Chairman of S4 Capital. He stays with us because I really want to talk about the metaverse. Coming up, we'll take a quantum leap into the metaverse and look at advertising opportunities. This is Bloomberg.
And click on it, we make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they are needed most.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now we're back with Sir Martin Sorrell, chairman of S4 Capital, who's still with us. And Sir Martin, we were talking a little bit before about the advertising world and some of the things that you're seeing. You're confident about the holiday season. You're confident about 2022. Talk to me about the metaverse. Now there's we saw Facebook being rebranded as Meta. I don't know whether that explained things or just confused a lot of people a lot more. But what is this world of metaverse, and what does it mean for advertisers?
Well, I think going back to Facebook for a minute, which we were involved in with the Facebook Connect conference, I think it's the third time that second time we've done it. What I think that was done for two reasons. Firstly, the pressure that Facebook was under, the change of name enabled them to look at things a little bit more differently. And the second thing was the opportunity that the metaverse actually does give. I mean, we are in this virtual reality in which we operate. So, for example, we will be streaming, I think it's from next week, 26 games in virtual reality, actual games in virtual reality on Verizon through their 5G network for the NBA. It's actually the third season that we've done it, so it's not new. We've been doing it for, this is the third year. We've done pop concerts, 3 million people virtually online for pop concert recently. So the sort of things that we're doing are really interesting, and the e-commerce applications are starting to gather momentum. Right. So, for example, a Nike or an Adidas, you could have an avatar of Francine. You could be trying on clothes. You could be trying on shoes. Order them and receive them at home.
A kinder avatar of Francine telling you the news, hard-earned chief executives. Martin, when you look at it, does it actually supplant?
Interesting thought.
Is it always? Does it supplant actually social media? So does the metaverse take over social media, or do you marry the two? And so does it actually make your channels of revenue smaller?
You can marry the two and you expand the primary demand, I guess, is the answer to that. So this is an alternative revenue source. I mean, we're starting to engage with clients. We've been hired as an agency of innovation or agency of record in innovation in a number of cases now around NFTs, around crypto, and around the metaverse too. So a lot of clients are starting to experiment. On our earnings presentation yesterday, Lewis Smithingham, who runs that part of our business, calls it the fifth industrial revolution. That may be going a little bit too far, but we'll see. His view is that it's rather like the web 20 years ago or so ago. Didn't have a strategy in relation to the web. You had a problem. So these are alternative revenue sources and commercial sources for our clients. So developing a strategy, Francine, around it is going to become critically important.
Going to be critical.
I mean, our revenue from,
if you look,
yes, go ahead.
If you look at your revenue, so in 10 years, right? Are we going to even be advertising on billboards anymore? So are advertisers going to be making like 80% in the metaverse, or is it going to be more balanced?
Well, I mean, if you look at advertising as a proportion of GDP, Francine, for example, in the US over the last 5 years, it has shrunk, that's total advertising, from about 2% of GDP to 1%. It's now forecast to reverse and go back up to 1.75%, so almost to where it was a few years ago. Why? Because of the growth of digital media. It's not because of any recovery, significant recovery over that period, over the, let's say, the next 5 years in traditional. So free-to-air TV, radio, magazines and newspapers, traditional outdoor will continue to be under pressure. The growth is going to come from the digital part of the industry. So, for example, this year, there's a lot of talk about the recovery of traditional, but there's been an incremental 100 billion that has been piled into digital online, principally through Google, Facebook, and Amazon, despite all the pressures around privacy and around content and privacy that all those pressures that the platforms have been under. So the answer to your question is over the next 5 years, don't know about 10 years, but over the next 5 years, we're going to see growth in the digital marketplace.
Excellent. I'll see you in the metaverse, but also hopefully beforehand. Sir Martin Sorrell there, chairman of S4 Capital, joining us from Amsterdam today. Now, coming up, we speak to the chief executive of an Australian startup that is attracting growing attention for its innovative use of technology and helping to reduce the carbon footprint of agriculture. That interview is coming up next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Britain is suffering from a power crunch. The country relies on other European nations for about 8% of its supply through undersea cables. Prices have been surging, and that's before the usual winter season pressures. What's the problem? Here are a few. First, demand has surged as Britain emerged from the pandemic. There's a natural gas shortage across Europe pushing up power prices. Making matters worse, the UK doesn't have as much gas in storage from Russia, the world's top exporter, as it usually holds this time of year. Next, too little wind and solar power. Finally, one of 2 electricity cables to France was damaged by a fire in September and won't be back to full strength until October 2023. In response, some UK utilities have been forced to use coal-burning plants, despite the push for more green energy. With all this, UK power prices hit records in September, and while costs have come down, they're still far higher than the average over the past 5 years. According to analysts, consumer electricity bills could jump by 30%. There could even be blackouts. So the UK economy could be facing dark times ahead.
That was the latest on the UK's power crunch. Now, agriculture has one of the heaviest footprints when it comes to carbon, and working to reduce the sector's impact on our climate is proving an extremely difficult challenge for policymakers across the globe. One Australian company believes that through the use of technology, agriculture can actually become a central part of the solution. Well, we're joined by Guy Hudson, the chief executive of that company. It's called Loam Bio, and he joins us now. Thank you so much, Guy, for joining us today. Now, first of all, can you just give us an idea of size and scope? So how much, increase of the amount of carbon that you can sequester per hectare is it compared to best practice?
Yeah, absolutely. So thank you very much for having us on. Our technology can multiply the amount of carbon sequestered in agricultural soils by a factor of 2 or 3. Currently, the technologies that are available to farming businesses can be quite costly to implement. And what's really exciting is being able to provide an opportunity for farmers to be able to deliver an increase in both the quantity and stability of carbon that is stored in soil, and therefore help us to dramatically improve the amount of carbon we can remove from the atmosphere.
So how affordable does it actually need to be, Guy, to make sure that actually farmers will integrate it within their tools without it being too expensive and therefore prohibitive?
Yeah, it's a great question. And I think really ultimately it comes down to the fundamental economics of not only how expensive it will be for them to improve the amount of carbon going into their soil, but the carbon price associated with it. Ultimately, what we're working on is technologies that will allow us to, at a low cost, increase the quantity and stability of carbon. And these are comparable to other agricultural input products. So at a cost that is dramatically less than a fundamental change in practices, which is the option that's available to them at the moment.
Guy, I mean, I guess, will your technology also be used to generate, for example, carbon offsets and credits? And if yes, what part of the industry would be most interested in buying this?
Yeah, absolutely. And I think this is an enormous opportunity. While we're facing one of the greatest challenges of our time, for those of us working on solutions, it's really a huge opportunity. So when we look at the potential opportunity for farmers to be able to participate in the carbon market, that's really where we can start to diversify revenue streams and for us to be able to work towards mobilizing the whole of agriculture behind carbon removal and ultimately improving the productivity of our agricultural land in the process.
Right. When will the technology be available? In which markets?
Yeah, so we, as you know, started in Australia and we were kind of in the back end of the worst drought that Australia has seen in a very long time. For Australia, our products are currently being trialled by some forward-thinking farmers right now. We're across 16 different diverse sites across the country. And then in the US, we're across 11 sites right now, trialing our products, giving us the opportunity to be able to understand their performance across a diverse range of different scenarios.
I mean, I think carbon sequestration, I have to give a massive shout out to our agriculture reporter in Sydney, Sibylla, who's been briefing me on some of the stuff. But if you look at carbon sequestration, it really relies on rainfall. We have a lot of droughts in Australia. Could that be your biggest challenge?
Yeah, when you look at the technologies that we're developing, really it's about how we can work with natural systems to improve the quantity of carbon going into the soil. In our case, we work with microbial technologies that grow with the plants and enhance the plant's natural ability to sequester carbon. So when we think about drought, as long as we are still growing a crop, as long as we're still growing crops in the land, we're able to sequester carbon. And what our technology does is maximize the amount of carbon, but also increases the stability of that carbon so that it will remain there for a longer period of time.
All right, thank you so much. The Loam Bio Chief Executive there, Guy Hudson, joining us on this pretty impressive and interesting technology. Now, Bloomberg Surveillance, of course, early edition continues in the next hour. We'll have plenty more, of course, also from Glasgow and COP26. A quick check on the markets. A lot of market movement, not only because of the inflation report yesterday that I have to say was extremely watched all across the world, but a lot of the focus is also on other things we're seeing, including the UK with that GDP figure. So first, let's check on the markets, and then we maybe get onto the business flash. If you look at stocks, they're pretty much steady. Again, U.S. futures also steady. Investors still trying to figure out the risk of higher inflation spurring action from monetary policy. Now let's get to your Bloomberg Business Flash. And Germany's Siemens says it expects profit margins to increase across its three main divisions next year. That's as the industrial giant reaps the benefits of a multi-year streamlining program. Now, the group reported net income of 6.7 billion euros for the full year, beating a consensus estimate for 5.7 billion euros. The company warned on pressures from component shortages and higher raw material prices in the coming months. And Elon Musk has offloaded $5 billion worth of Tesla stock just days after holding a Twitter poll on his stake in the company. Well, the car maker's chief executive, the world's richest person, has so far disposed of more than 4.5 million shares, his first sales in more than 5 years. Now, the regulatory filings shed no light on whether he'll keep on selling to meet the 10% proposed in the poll. And Rivian shares soared as much as 53% in its U.S. trading debut before giving up some of that gain, while the EV maker's market value briefly topped $100 billion, putting it on par with General Motors and making it worth more than Ford. It's the biggest listing in the world so far this year. We have some great conversations, of course, about Rivian, and our Ed Ludlow also interviewed the chief executive yesterday, so we'll bring you that throughout the day. There's a Saudi investor and also Amazon backing Rivian. This is Bloomberg.
Подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Тоже это не просто, в чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. Ну, то есть второй будет проще.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Inflation is high, higher. It's eye-popping. This is a transitory period.
This time, the faith in the Fed is so complete that when they say it's temporary, we believe it.
I would say the biggest challenge that we have is really the health of the supply chain.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, November the 11th. Our top stories today. Elon Musk's big sale. The richest person in the world sells $5 billion of Tesla shares. It's the first time he's sold any of his stake in 5 years. Warning signals from Disney. Streaming growth at the world's largest entertainment company slows down. And if inflation's the problem, President Biden says he has the cure. He concedes price pressures are real, but suggests his infrastructure bill is part of the solution. Welcome to the program, everybody. I'm Anna Edwards with Danny Berger in London and Matt Miller in New York. Kaylee Lines is off this week. Matt, good morning then from London. So inflation clearly a focus. Will central banks globally in the United States and elsewhere hold their nerve as we're set for more eye-popping inflation numbers through the winter?
Yeah, well, I mean, they have held their nerve pretty well. If you look at Daybreak today and see the real rates chart, it's pretty amazing how low it is. In the U.S., you know, we're looking at 6.2% CPI, so that brings the real rate pretty low. Take a look at what's going on here in Asia. We see some big gains, especially in China. The CSI 300 up 1.6% at the close, but the Hang Seng also gaining 1%, and the Nikkei up 0.6%. So these inflation concerns not bothering Chinese or Asian equity investors. We also see the dollar continuing to gain ground against the Japanese yen. Remember, yesterday we could buy 113 yen for your dollar. Today you can buy 114 yen for your dollar. In terms of the U.S. market, it is Veterans Day, so there won't be any bond trading today. We will trade equities. S&P futures are up as well, about 1/3 of 1% right now. NYMEX crude gaining 70 cents a barrel to 82.04. I will say that Brent is gaining a little bit more. So if you look at your CO1 instead of your CL1, you're going to see a bigger gain there. I have Ethereum up here as well as Bitcoin because Ken Griffin, who was a longtime Bitcoin and really crypto bear, has now said that he thinks Ethereum is going to drastically outperform Bitcoin. He said it's going to take over as kind of the main blockchain technology, and it's up 3.9% today. Bitcoin up 1.6%. This kind of mirrors what we've seen year to date. Bitcoin's been great. It's been on fire, but Ethereum has risen even further, even faster. So it looks like it's outperforming, even though it's at a smaller level. Danny, what are you looking at?
Well, sticking with the big theme of today, I have some news breaking for us on euro area inflation. This is from the European Commission putting out their new figures, Matt, and they are saying that signs of elevated inflation, that it's largely transitory. So I have the numbers breaking for us. So they're seeing in 2022 at 2.2%, and then in 2023 it should subside to 1.4%. So I do have a chart in front of me for our radio listeners. Basically, what we're seeing is an elevated new inflation forecast, but not dramatic enough to really get past this idea that inflation is transitory. Well, when it comes to the market picture today, it is a mixed one. We have some countries outperforming more than others. We're coming off the back of another all-time high for European assets. There might be a little bit of an idea of catching up to some of the declines in U.S. stocks yesterday after that hotter CPI number, but we are looking at a DAX that's positive, up 0.2%. French stocks doing well as well, up 0.3%, and a FTSE 100 that's up 0.4%. Might also have some currency effects playing into this. A really strong dollar, again, off the back of those inflation readings. That means a weaker cable rate, and that in turn means that those big internationals in the UK outperform. Let me dig into some more of the currencies, though, because the euro, as you would expect, is also looking weaker versus the dollar because of that one-year high on the greenback as those inflation expectations pick up. But also, the lira is something we need to focus on. We are at 9.9253 on the dollar-lira cross. This is getting extremely close to reaching 10 lira a dollar. This would, of course, be another record. It has to do with the strong dollar, but at the same time, this rate-cutting path that Turkey has gone on. Now, in terms of the equity market, again, we're seeing basic resources outperform. Iron ore has rebounded. And Anna, I think Burberry is a really fascinating story. Luxury in general, down 6%, missing their sales target. This concern not only about virus restrictions in China, but the policy of common prosperity. Will that mean that if you're in China, you just don't want to own a big, loud, fancy designer handbag anymore?
Yeah, actually, in Burberry pushing back against the extent to which this was a damaging phenomenon for them. But we had heard from Ferragamo and others in the luxury sector, and so that sector was already under pressure this week as a result of the links between common prosperity and luxury purchases. Let's skip to another bit of news flow that I think everyone needs to know about, and this comes to us from Belarus. Lukashenko, this is the Belarusian president, Alexander Lukashenko, says he might consider shutting down a gas pipeline that links Belarus to the EU. This is according to Belta. The pipeline in question is the Yamal-Europe gas pipeline. It passes through Belarus territory. There's been a standoff at the border between Belarus and Poland, between Belarus and the European Union of late. The Europeans blame the Belarusian president, says he's bringing in migrants and taking them to the border. The Belarus government denies this. The EU is considering sanctions, and this is the latest salvo then from Belarus on that subject. Let's put the geopolitics to one side for just a moment and think about where we are on the day's agenda. Here's a look at what is ahead for us. The bond markets, just a reminder, are closed in the United States today in observance of Veterans Day. We have a bank decision, a central bank decision to come. Mexico's central bank will release its latest rate decision, in focus globally, of course, because of the big inflation push we're seeing. China holds its annual Singles Day, the world's biggest shopping festival. How does that rub up against common prosperity? That's a big theme. And US Vice President Kamala Harris is in France to meet with the French President Emmanuel Macron and to speak at the Paris Peace Forum, and perhaps trying to mend relations a little bit, Danny, between France and the United States.
Well, one area of this market that will see no peace anytime soon is investors in Tesla. Elon Musk, the world's richest man, has just sold an additional $5 billion worth of Tesla shares. That's on top of the previously reported $1.1 billion worth that he liquidated to cover tax obligations. Alex Webb, Bloomberg, a quick take reporter, joins us now for more. So, Alex, how close are we at this moment to getting to that 10% sale that Musk had put out on his Twitter poll?
There's still quite a way to go. That would be closer to the sort of 15-20 billion range, obviously depending on where the stock is. Perhaps that means that there is more to come. Obviously, we don't quite know. It seems as though he's fulfilling that promise, if indeed that is the intention. Was this something that he was going to do anyway, and perhaps the Twitter thing was cover, or is it something that very much was prompted by the Twitter poll?
Rivian, meanwhile, ended its first day as a public company, valued at $88 billion. The electric truck maker more than tripling its last private valuation after investors piled into the biggest IPO this year. The CEO spoke to Ed Ludlow about the challenges ahead.
I would say the biggest challenge that we have, and I would say broadly across many industries, is really the health of the supply chain. And if you think about building a vehicle like this, like our R1T, there's around 2,000 parts that come in from end item parts that come from suppliers. And this is one of those rare situations where a 99.5% is not good enough.
I wonder how much attention this is getting worldwide, Alex, because, of course, pickup trucks aren't as important for the rest of the world as they are in the U.S. Nonetheless, this is a huge IPO, I think the 6th biggest of all time.
Quite astonishing, really, if you think about this company that's almost pre-revenue. It does have orders in, not least from Amazon, but if you check out its financials on the terminal, doesn't have any earnings this year, and so how that works with multiples, where it's trading at fundamentally an infinite multiple of its earnings. It clearly has got a lot of promise because not only does it have Amazon and Ford as shareholders, Amazon, as I said, has made big orders from it for delivery trucks. And so this is, for now, it seems, fundamentally a company that's addressing the US market. But perhaps for investors trying to get into the ground floor, they're saying, well, could this be the next Tesla? Therefore, on that basis, we think it's probably quite discounted to where Tesla is. It's still also quite a lot of wishful thinking if you consider the fact that Tesla's overvalued as well. So there's a lot of complicated moving parts.
Must be very difficult to value when you think, is it a value versus the rest of the auto space or is it versus Tesla? And you might get to a very different answer. Alex, thank you very much. Bloomberg's Alex Webb with the latest on the electric vehicles phenomenon and indeed the Tesla news flow. A slowdown for subscribers, sticking with technology themes, I guess, a slowdown for subscribers for Disney Plus might have some investors worried, but the world's largest entertainment company is hoping a splurge on new content will be the magic solution. Disney CEO Bob Chapek spoke on the company's earnings call.
We announced at our last investor day that we expect our total content expense to be between $8 and $9 billion in fiscal 2024. And we will now be increasing that investment further, with the primary driver being more local and regional content.
Bloomberg's Laura Wright joins us with more. Laura, what did we learn then from the Disney earnings, the focus very much on these subscriber disappointments?
Absolutely. We learned that Disney gained 2 million additional subscribers. That was 1 million less than the street's expectations. It means that Disney Plus's total subscribers now stands at 118 million. Bob Chapek was very bullish about the company's ability to push out new content in the second half of next year. In terms of the legacy parts of the business, Parks operating income was strong, $640 million. The linear networks that include ESPN as well as ABC, profit fell 11% there because of higher costs for marketing and programming.
Hey, Laura, thanks very much for following Disney for us. We'll catch up with you a little bit later. Laura, right there on the media beat today. Now, President Joe Biden says his soon-to-be signed infrastructure legislation is part of the solution to decelerating, to slowing down U.S. inflation. He spoke to the Port of Baltimore yesterday.
According to economic experts, this bill is going to ease inflationary pressures, lowering the cost of working families.
Jack Fitzpatrick, Bloomberg government reporter, joining us now from Washington. And Jack, it's interesting because a lot of critics say that these huge spending plans are responsible for boosting inflation, not that they'll slow it down.
That's right. And you saw the president try to address very aggressively all the talk about inflation, acknowledging in ways you probably wouldn't expect from a Democrat, even emphasized gas prices in California, which is a big Republican talking point right now. Now, the economists he cited on the anti-inflationary pressure of this hard infrastructure bill really made the point that that is a long-term issue, that you can't do much with an infrastructure bill to, in the next year or two, reduce inflation. A lot of the money that goes out in this infrastructure bill is really around 2024 through 27 or so. And yes, the point remains that in the next big bill that Democrats also want to pass, the social tax and spending bill through reconciliation, could add some at least moderate inflationary pressure, because so much of the spending comes in the early years before the tax revenue offsets that. So the issue absolutely does remain, and the anti-inflationary issue that he mentioned is much more long-term.
Jack, let's think global geopolitics and give us a take from Washington on the US-China climate deal. These two superpowers agreeing to work together on slowing global warming, which from a European standpoint looks fairly significant and, of course, comes just before a key meeting between the two leaders.
Yeah, there is a scheduled virtual meeting between President Biden and President Xi on Monday. There's not a lot of specifics on the pre-readout of how that's going to go, but it is absolutely safe to expect that climate will be one of the topics of conversation. And some of the letters exchanged by diplomats ahead of this that are essentially a preview, the climate cooperation between the U.S. and China is something mentioned, and the president also mentioned, of course, the COVID-19 cooperation to the extent that it has existed. But this is sort of still an early step, this agreement between the U.S. and China, with some mentions of China phasing out coal, but not hard differences in the goals on emissions. So there's still work left to do, but it is a bit of a step forward between these two countries.
Jack, thanks so much. Jack Fitzpatrick there of Bloomberg Government talking to us about President Biden and President Xi. Let's take a look now at some of the stocks moving in the pre-market today. Beyond Meat is a big loser, down 20% in the pre-market after they forecast fourth quarter sales that missed analyst estimates. They now expect between $85 and $110 billion in the fourth quarter, and frankly, they used every excuse in the book. Labor shortage, storm damage, Delta variant. They didn't say anything about microchips, which I will give them. Disney is also one that we've been talking about. Smaller than expected rise in streaming subscribers. In fact, 2.1 million in the fiscal fourth quarter. That brings the total to a little more than 118 million, and analysts on the street were looking for 119.6 million. So missing by a lot. In fact, that's the smallest quarterly gain they've seen to their streaming service since they launched 2 years ago. And then finally, DiDi Global. This is the ride-sharing service that, of course, has been in the news lately because of its, well, first the huge IPO, then the problem with the IPO because China regulation. DiDi is going to reintroduce its apps in China by year end. This according to Reuters, as this Chinese regulatory investigation wraps up. The stock had been up as much as 13% in the pre-market. Now it's just 4.5%. But we should point out it's also down 36% since the IPO. So it hasn't paid off as well as investors and may have hoped this year.
Yeah, interesting one to watch in the context of whether we're going to start to get a handle on the limits of the common prosperity drive in China. So worth noting. But Matt, coming up on the program then, investors weighing the hottest U.S. inflation print in 3 decades. We'll discuss that with Charlotte Ryland of CCLA and the new inflation hedge, how crypto is reacting to the beat in U.S. CPI. Plus, San Francisco Fed President Mary Daly gives us her view on what she calls eye-popping inflation. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards and Danny Berger in London. Now, I've got a great chart that I can explain for those of you listening on radio. It's a pretty simple concept, but I think a pretty shocking result. So if you buy and hold stocks, hoping that the dividend yield will eventually pay back your capital, that worked pretty well in the 70s, in the 80s, in the 90s. You basically had to wait 20 to 30 years before dividends repaid your capital, and after that, everything was gravy. So about the length of a mortgage, pretty cool for Americans. Then it started to blow up. In 2000, it took 84 years. It got back to 53 in 2010, and now we're back out to 79 years because the dividend yield is so low. The 12-month gross dividend yield on the S&P 500 is just 1.27%. Ben Rahm joins us, currency and rate strategist for Bloomberg M Live. And full disclosure, he made up this chart. I just stole it from him. Ben, I just thought it was so fascinating that it's taking now so long because rates are so low.
Well, Matt, the chart is public property. Yes, it's incredible how much we have run up on stocks, probably because of the loose monetary policy aiding the froth in the markets. A while ago, I looked at it from a different perspective in terms of GDP output. If you look at the market capitalization of the entire US markets, it's about 51 trillion plus at the moment. So if you combine to get that number, you need to combine the economic output of all the workers working in the top 5 economies in the world for an entire year to get that kind of output. Now that puts into perspective how much equities have run up. And of course, that comes against the backdrop of loose monetary policy and investors' enduring search for yields.
Yes, and where do we stand? And with that in mind, I mean, one of the reasons for that run-up in equities, low real yields on bond markets, and bond markets certainly responded to the CPI number, as did the dollar. I want to think about your FX expertise here, then, because the dollar's stronger once again today. How does this pan out through the winter, do you think, as we continue to ask questions of these central banks?
Well, I do think that the dollar has strength, has room to run up from here. And I think that we are still far below the levels that prevailed a couple of years ago. And I think that as the Fed shows, as the inflation numbers suggest that the markets have aggressively repriced after those inflation numbers, money markets, saying that the Fed will have to raise rates. And if they have to raise rates aggressively, and I think that the dollar has far more upside than the markets are factoring in at the moment.
Okay, we'll look for that then, Ben. Thank you very much, Ben Rahm from Bloomberg's Markets Live blog. And you can get further market analysis. Check out the MLIV Go function on your Bloomberg terminal. This is Bloomberg.
common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now.
Wrap it
into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know, what the challenges with getting people back into the workforce.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to Bloomberg Surveillance Early Edition. We mentioned earlier this week we're watching things emanating from China, the 6th plenum taking place for the Chinese Communist Party, and we've been focusing on it. The key Communist Party summit has concluded now in Beijing. We've been getting these headlines over the last few minutes. Important to bring them to you. China has issued its first resolution on party history since 1981. And Matt, just to underline the significance of this, we have only heard this kind of resolution from the Chinese Communist Party 2 times in history, once in 1945 under Mao Zedong and once in 1981 under Deng Xiaoping. So that adds the long lens of history to what we're hearing from China today.
Yeah, absolutely. It shows how powerful Xi Jinping is, and maybe it should worry some who have seen him withdraw from the international stage. I noticed a couple headlines here that they're vowing to take leadership in cross-strait relations, and they're vowing to be proactive in cross-strait relations. They probably, you know, weren't ceding leadership previously and weren't doing nothing about it before, but this could be a warning to the U.S. about Taiwan.
Right. Well, to your point, Matt, the difference from last time is China is bigger now and has a bigger military and more influence in the economy.
Absolutely. We'll think about these geopolitical developments, then we'll get back to our market conversation as well. But we will talk about China with Charlotte Ryland, CCLA Investment Management Co-Head of Investments. That conversation next. This is Bloomberg.
700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger here in London and Matt Miller in New York. Kaylee Lines is off this week. Danny, just looking at European equity markets and making really quite modest gains. Looks as if we're set, though, for a rebound on the NASDAQ after yesterday's heavy selling. No surprises that we saw that selling after the strong 30-year high that we saw on U.S. inflation.
Right. It is this constant concern that these elevated valuations are not going to be sustainable once rates start to pick up. And, of course, the market got a relief with maybe the Fed not necessarily all the way dovish, but in their last meeting, just really echoing patience. But if we keep getting these hot numbers, at what point do you need to rethink the reliability of the growth trade, of the big tech trade? I mean, even Tesla is up today after we learned of further selling from Elon Musk.
Yeah, so recovery perhaps in tech stocks, a bit of a theme ahead of the US Open. Matt, also looking at the global bond markets, repositioning around this theme once again of faster rate hikes from central banks. What's on your mind as we head towards the start of US trade?
Well, I am reminded, and you'll see a lot of people wearing poppies today, that it's Veterans Day. Our bond markets here in the U.S., of course, are closed in honor of that holiday. We do have equity markets ready to open right now. You said the Stocks Europe 600 was up just marginally, less than 0.1%, but S&P futures are up about 0.4%. So it looks like there are going to be some gains powered by something that Danny said, Tesla and other mega cap tech stocks. NYMEX crude now really unchanged at 81.41. A much bigger gain in Brent, the global benchmark, but WTI is not doing too much as the dollar gains so much strength. Bitcoin is up 1.25%, 1.4%, regardless of the strength in the dollar. And I should point out, Ether is up even more, as Ken Griffin says he likes it better, and he's a crypto bear. So that's very interesting. I'd like to take a look at some of the pre-market movers. Beyond Meat still down about 20% in the pre-market after missing or disappointing with its fourth quarter forecast. It only plans to sell between $85 and $110 million worth of fake meat in the fourth quarter. Disney down after adding the fewest subscribers that it's added in a quarter in the 2 years since it started its streaming service in the fiscal fourth quarter. Tesla, as Danny said, is up in the pre-market 3.33%. Maybe some investors think Elon Musk has the sales behind him because he's raised the money he needs to pay the IRS, but maybe he's going to continue selling. He was going to get rid of 10% of his stake in Rivian. Yesterday, its first day of trading, went out at $78, jumped up at one point to 120. Now it's trading at 108 in the pre-market. Still, it's an $85–90 billion company, so it's already worth more than Ford or General Motors. Danny, what are you watching?
Eye-popping numbers there. Well, I'm watching other eye-popping numbers that, of course, got everyone's attention yesterday, and that was inflation and how this is turning increasingly into a political issue for the White House, with Biden yesterday saying, okay, inflation is high, but jobs are up and wages are up. Well, I have a chart that really illustrates the issue with that, and I welcome our radio listeners as well. I know you can't see this. Let me explain this to you. It is the real earnings, the real average weekly earnings, which, of course, means earnings, wages adjusted for inflation. Now, we saw a big drop-off at the start of this year, but since then, real wages adjusted for inflation continue to be negative, and at the same time, they still are below the long-running average. Now, add on top of that, we are seeing signs that Americans are continuing to shop at discount stores. So how severely has their pricing pressures been curtailed? Well, let's dig into this more. Let's bring in our next guest, Charlotte Ryland, co-head investments at CCLA Investment Management, who joins us now. Charlotte, good morning to you. At what point does this picture of lower wages, when you take into account inflation, start to eat into demand?
Yeah, absolutely. And I think that's definitely one of the concerns. I mean, certainly looking at the UK, we're beginning to see sort of some weaker consumer numbers coming through as well. And it's exactly the same issue. You've got, particularly at the lower end, a lot of price pressures, whether it be, the cost of heating your house or just buying, basics like food, not needing to mention, getting ready for the holiday season. So, yeah, that absolutely is a concern. And you're beginning to see, in certain areas, there are some wage pressures coming through, the hospitality industry in particular. We've seen, some pressures there, maybe some areas like truck drivers and things like that. But, generally wage inflation hasn't really been picking up. And so if these inflationary pressures don't prove transitory, which of course is what the central banks have been saying, that definitely could start to cause a problem for the consumer.
It's interesting. Good morning to you, Charlotte. I spoke to a guest from Barclays earlier on who was talking about how he sees a kind of Goldilocks situation for stocks at this point, because real yields are so negative, remain so negative, and inflation so high. The whole Tina narrative, there is no alternative, seems to reign supreme. But you see inflation then could be a threat to the stock rally we've seen.
I mean, I think our core view is certainly that we're not going to carry on seeing, 6% CPI that we saw in the US yesterday. We would expect that to calm down, and a lot of the pandemic-related bottlenecks will begin to ease as we move into next year. But yeah, I think longer term we have got concerns, particularly about China, which has been one of the big areas exporting deflation to the rest of the world for a very long time, and that's been particularly noticeable in durable goods. As that economy begins to age, as the working population begins to shrink, as the cost of doing things within China rises, that will no longer be such a sort of positive force. So I think inflation not as high as it is at the moment, definitely, but certainly could be a little bit higher. Does that derail the market? I mean, I think it makes it pretty bad news for the bond market, and we think that's very unattractive. I think if you're in the right kind of equities, the ones with high margins, with pricing power, with some kind of other long-term growth drivers behind them, I think there's still room to run.
We're getting a lot of lines coming out of China this morning, Charlotte, around the plenum that's taking place ahead of important events next year. The Communist Party calling on China to unite behind Xi Jinping, and a lot of people saying that it will enable him to have a third term, and this could mean that he rules for life. What assumptions are you making about his leadership and what that does to China around zero tolerance of COVID, around common prosperity, and the way that all of those things are rubbing together?
Yeah, I mean, I think that's definitely been one of the themes this year, hasn't it? In terms of sort of regulation, we've seen things like the education sector. I mean, it's been quite interesting, the fact that China has been, with this zero COVID policy, just cutting itself off from the outside world. And if that continues, I think that's definitely not terribly good news. But I mean, this still remains, the world's second largest economy. It's still extremely dynamic, particularly in some of the areas, technology areas. It's still an area of, huge growth within the middle class. So it's still reasonably positive on China, but it's definitely an area that, that politics is certainly something that we need to keep a very close eye on.
How do you invest in China?
For us, primarily through, Western quoted companies, so it could be, some of the consumer players, things like Estee Lauder, it could be, or L'Oreal, or some of the luxury goods names, things like LVMH, that kind of thing. So we don't tend particularly to invest actually directly within China, partly due to sort of governance concerns.
What do you think about the automaker valuations that we're seeing here, Charlotte? I only ask because Rivian is now worth more than Ford or General Motors. Volkswagen is still worth more at $140 billion, but it's not the $1 trillion valuation that Tesla has. And it strikes me as, it may be dangerous over the longer term that investors are willing to give so much credit to these startups, and I know Tesla's been around for a decade, but still, compared to Volkswagen or Toyota or the Ford Motor Company, it's gonna have a difficult time over the next 10, 20 years.
Yeah, I think, we struggle with the valuation of Tesla. I mean, yes, we're all moving to EVs, and that's a great opportunity for them. They've been the sort of the market leader in that area. But the fact that they're valued at the same as the next 10 largest auto companies, and things like Toyota, things like VW, have got sizable, EV businesses themselves. So, we definitely struggle to see that that's an entirely justifiable valuation.
Charlotte, thank you very much. Thanks for joining us. Charlotte Ryland, co-head of investments at CCLA Investment Management. Interesting conversation. Thank you. Coming up on this program, crypto's three musketeers. What's behind the $3 trillion market cap in digital coins? That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards and Danny Berger in London. Let's turn now to crypto. Bitcoin briefly flirted with $69,000 for the first time before paring gains after yesterday's inflation print. Maybe a little bit of buy the rumor, sell the news there. Here you can see it trading at $65,267. Mike McGlone joins us, Bloomberg Intelligence commodity strategist, for more. And Mike, I wonder, how much do investors really think of Bitcoin or crypto as an inflation hedge?
Well, I hear that narrative a lot, Matt, and I like to push back on a little because it'll be inflation hedged someday. When it gets to that higher plateau, it settles in and volatility declines. Right now, I view it as more of a price discovery stage. But if you're looking for inflation hedge going forward, your choices are gold, commodities, and Bitcoin. And the upside of those three is much more in Bitcoin. I think that's what's happening. So I view it's going to get there, but not yet.
Ken Griffin has been a crypto bear. Now, though, he says he likes Ether, and he says, in fact, that he thinks Ether is going to overtake Bitcoin as the kind of blockchain of choice. How central is that view, or how consensus, I should say, is that view?
Well, I think the consensus is the macro. He's just one of those naysayers who's come over to the mainstream now, which is you got to be in it, or you fear, or your greater risk is being on zero. So everybody's getting off zero. I think that's the stage. Having a balanced portfolio that has Bitcoin and Ethereum makes a lot of sense in it. Picking a winner, just Bitcoin and just Ethereum, maybe doesn't. But to me, that's where the price is going. The key thing is a big difference. Ethereum is becoming the collateral of the internet. You look at NFTs, they're all based in Ethereum. You like crypto dollars, they're all based in Ethereum tokens. And Bitcoin is becoming the collateral of the world. It's replacing gold as a digital reserve asset. So different assets, but they fit well in a portfolio as in a diversified portfolio. And that's what Tim Cook said the other day.
Okay, there's plenty of voices, though, that would talk about the regulatory risk that maybe hangs over some of these cryptos, Mike. And we certainly saw the Fed raising a flag about stable coins, ones that try to peg their value to something else externally. What are your thoughts on stable coins, Mike?
Oh, that's exactly a place on it where it's going, where regulation's going, is crypto dollars. The most widely traded assets on the planet in token and in crypto land are crypto dollars. They're all based in Ethereum tokens, and that's where regulation is going, but it's just a better way to do business. You can transact 24/7, instant settlement, you get a yield that's better than Eurodollars. So it's just like the automobile replacing the horse. The buggy makers aren't happy, but they'll come around to it. And it's a key thing is it pushes back against China. Why did China ban all cryptocurrencies? Partly because the whole market's gone to the dollar organically in stable coins. And they're trying to launch a CBDC in China. I like to say, good luck with that. When the world says we want dollars, we want it in a token basis, and it's just a matter of time that U.S. regulates it properly.
Mike, we were showing a chart just a bit ago that showed just how much Ethereum has gained versus Bitcoin, about 5 times so far year to date. Are we already in a realm where the momentum, the big mo, if we just look at it in that regard, is behind Ethereum and not Bitcoin?
Well, they have both good momentum, Danny. And the key difference with most other assets this year, most notably the stock market, is both those, Bitcoin and Ethereum, have corrected almost 60%. It flushed out the excesses, created a good foundation, and now we're back onto that time of year where they usually advance, and they have good, solid, fundamental underpinnings. NGU technology is kicked in Bitcoin. It's very complicated. And Ethereum, that's called number go up. Supply is declining. They had a protocol change. Supply is declining in Bitcoin, and demand and adoption are increasing. So I look at it as a commodity guy. Price must go up. It's just how you measure that. Is it overbought, oversold? And I see right now they're on good, solid trajectories to the upside.
How do you factor in EMH, in the words of Matt Levine, Elon market hypothesis, that anything related to Elon is what's moving Bitcoin, and more specifically lately, this idea that if he's selling Tesla, it's going into Bitcoin. Is that been a driver as of late?
Oh, yes. Well, that's one of the significance of this year is selling Tesla. You know, it's the valuation of the 10 top automakers together. You could say it's a little bit expensive. Yes, I believe in the technology. I drive an electric car. It's not a Tesla, but everybody's going there. And then you have Bitcoin, digital reserve assets. To me, that's a great narrative. Yes, there's volatility around what Elon Musk says, and it's most people in Bitcoin say, thank you for pointing out the energy consumption, because that's part of the strength. It gave the market a dip, and we're going back up to trend. So that's a key thing to remember. We're getting a lot of profits in equities. A lot of that's going to trickle over to Bitcoin and Ethereum, and there's not much left in bonds. And gold is not moving. Gold is being replaced. So all that means this new asset class is gaining space. Tesla's a good indicator. The stock market, I point out, the next time it corrects, Bitcoin will drop too, but it'll probably come out better off than the stock market.
Okay, but in terms of those inflation hedges, just worth remembering, gold did pop yesterday on the inflation numbers out of the US and held on to those gains, whereas Bitcoin gave its up. Mike, thank you so much for joining us with your views. Mike McGlone of Bloomberg Intelligence with his views on the crypto universe. Coming up on this program, eye-popping inflation, part of our interview, our conversation with the San Francisco Fed President Mary Daly. That's next. This is Bloomberg.
Its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger alongside Anna Edwards in London and Matt Miller in New York. Now, San Francisco Fed President Mary Daly sat down with Bloomberg's Michael McKee after yesterday's eye-popping inflation numbers.
We have a challenge right now. Inflation is higher. It's eye-popping, right? It catches people's attention and it hurts their pocketbooks. The issue, though, is that we still have COVID. And COVID's still an issue globally, and that's affecting supply chains. It's affecting the ability to go out and buy services. It's affecting the ability to meet in person. This is my first in-person meeting. And that matters for inflation. It matters for jobs. And so this is a transitory period. That's what we believe. That's what I think when I look out at the data. But it's directly related to COVID. And as quicker we get through COVID, the better off we're going to be as an economy.
With real yields at about negative 6%, you're still really stimulating the economy. Financial conditions get looser all the time. Does this change your calculation for when you might have to raise rates?
Well, I think right now it would be premature to start changing our calculations about raising rates. We're certainly data dependent, but really we're still focused on as COVID goes, so goes the economy. And the higher inflation readings certainly have my attention. I'm watching inflation expectations as well. That has my attention. But the other side of this is the number of missing jobs has my attention. The number of women home taking care of children has my attention. The number of people who were displaced and haven't come back, that has my attention. And ultimately, you know, we have a full employment and price stability mandate, and we're trying to balance those things and make sure that we have an economy that is self-sustaining once we get through COVID and really has the legs under it to deliver to Americans what they want, which is, you know, price stability, full employment, and the ability to participate in the economy.
San Francisco Fed President Mary Daly there speaking with Michael McKee. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now to talk about inflation. And Tom, I noticed we had the biggest gain in prices since 1990. I was trying to think of a good way to date that. That was before Nirvana released Nevermind, before Pearl Jam released 10, really the beginning of the second era of classic rock.
It was. We did that yesterday on radio, and you're absolutely right, Matt Miller, the great demarcation between Wilson Phillips and Nirvana. It was an abrupt shift to say, and it was good to hear Hold On again, one of Glenn Ballard's great efforts. Let's go to the chart right now, and the chart is the partition of inflation. It's simple. The white line is services inflation, about where it is, and it's the goods boom, the goods disinflation that we've seen for a good number of years, 5-6 years. It is so over, at least for now, with a moonshot straight up from the green circle up to that red circle, and it sums out at that painful 6% statistic.
Tom, good morning. Really interesting then to think about where we go on the inflation narrative with that chart in mind over the winter, whether central banks hold their nerve with the transitory drum that they've been banging.
Well, holding the nerves is the right idea. The fancy PhDs, Anna, will say it is somewhat transitory. Maybe they vary on that. I know Dr. Larian's been very vocal on that, but the fact is they're going to wait and see and wait for the data. Unfortunately, and I would speak to Europe's heating bills will be very different. America's heating bills will be bad, but Europe, so deregulated, will be much more painful.
Tom, I know you have some fascinating conversations to come. Leon Cooperman, you're speaking with later, will definitely be interesting to get his take on these issues as well. Tom, we're looking forward to that. That's Tom Keene, co-anchor of Bloomberg Surveillance. Thank you so much. Now, let's get a look at what else we're watching today. And I am watching Singles Day in China. Of course, this is the big shopping event of the year, not just in China, but globally. Singles Day, the e-commerce event, brings in more sales than all of Thanksgiving through Cyber Monday. This year will be particularly fascinating, though, because not only do we have a crackdown on tech regulation that might affect this year's event, but also this idea of common prosperity following China's plenum. This year, Alibaba executives have said that they want to pivot towards sustainable growth versus just pure gross merchandise value growth. So perhaps trying to adjust and really fit in to that common prosperity narrative, Matt.
It's a shopping holiday. Kind of like Christmas. I'm watching Lukashenko warning that he could shut down the gas transit to the EU. Anna pointed out which pipeline runs through Belarus. I can't remember what it was. But the point is, he is making it very clear that the European Union, that Angela Merkel and everyone else there is at the mercy of Eastern Europe and really Russia when it comes to heating homes, powering the economy. He's sort of underlining that fact, and it's a very dangerous point to make. I'm not sure why Germany has gone along with this the whole time. Maybe they didn't have any other choice, but certainly getting out of nuclear and counting on Putin doesn't seem like the best strategy.
Yamal, Europe is the gas pipeline that you were trying to remember the name of. That is the one that runs through Belarus, Matt. And to Tom Keene's point, this is what is putting this upward pressure, or has been putting upward pressure on gas prices and other energy prices here in Europe. This is part of the story anyway. Let me tell you, I'm also watching what's going on in China. We've already been bringing you the headlines throughout the hour coming through from China. The resolution being passed by the party, a resolution on party history. The first time since 1981 we have seen one of these. So we saw one under Deng Xiaoping in 81, one under Mao Zedong in 1945. So this is the kind of lens that Xi Jinping, you're seeing here on your screens right now, is drawing on as he tries to assert his authority even further. This is a strong sign, we're told then, that he is going to be able to clinch a third term. That would be historic. We haven't seen
forever
that
term
in the past. Or forever term, indeed. And where does that leave his key drives around common prosperity? Where does it leave, in the short term, the zero tolerance around COVID? That'll be an interesting one to watch in terms of what the Chinese economy can deliver. More Bloomberg surveillance is, of course, straight ahead. We'll be hearing from Leon Cooperman, who's going to be joining Tom Keene and the team a little bit later on this morning. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that as either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Brambitz. I'm Jonathan Ferro. It is Veterans Day in America. It is Remembrance Day across the Commonwealth. In London, on the 11th hour of the 11th day of the 11th month, we pause for a moment of silence. The pictures coming in from around the UK, pictures of Big Ben, Tom, the cenotaph, the War Memorial in Whitehall, London, the National War Memorial in the United Kingdom.
Interesting to see always, and for those on radio, the multinational feel of this with the First Minister of Scotland, among others. Vice President Harris is in Paris with Mr. Macron at their remembrances. John, the scope and scale here always needs to be remembered to Americans like myself. And John, with 300,000 total casualties, deaths and injured in World War I, completely dwarfed by the British experience, 10 times larger at 3 million, and no one more affected than France with 6 million total casualties, and then Russia hit hardest.
Remembrance Day in London, across the Commonwealth, around the world, Tom, and Veterans Day here in the United States. A moment of silence coming up in the 9 o'clock hour around the opening bell, which of course we will observe. From New York City this morning, good morning to you all. Your equity market is open, your bond market is closed. Equity futures up 14 on the S&P 500, up a third of 1%. And Tom, in many ways, the story of yesterday, the story of today, 6% inflation in America.
We're all coming to grips with it. It's amazing, John, how we spend all our time predicting all this stuff, and yet when the news actually shows up, it's like, oh, and all the charts that we saw in the media yesterday. John, what I would really emphasize, except for the brief shining moment of 1990, this inflation is Volcker vintage.
Elisa, we talked about the sticker shock of 6% yesterday, and Tom, you're right to bring it back to the 90s. The sticker shock of 6%, and the difference between 5.9 and 6.2 is far more than 30 basis points. 5.9 was the estimate, 6.2. It got a lot of people talking about a lot of things.
And frankly, in the bond market, I know it's closed today, but yesterday you saw a complete repricing of a number of different things. First of all, bringing forward rate hikes, expecting the Fed to have to move sooner. This was a widespread feeling in bond markets and frankly equity markets. But on the long end, this feeling that we have wildly mispriced perhaps the long end of the yield curve, long-term rates in an environment where inflation might look different.
Messy auction yesterday. Let's whip through the price action for you. The US bond market is closed. Did you watch that one, Tom?
I did.
Your equity market open up 15 on the S&P. We advanced a third of 1%. Futures advance. Yields in Germany, maybe one to watch. Negative 25 after coming close to breaking zero. We back away once more. But TK, we've got to talk about it. The front end repricing for a conversation about rate hikes all over again. And to Lisa's point, later in the day at the long end, just a messy auction, bringing a little bit of weakness, a lot of weakness, in fact, to the long end of the curve.
And I look, John, at the dollar movement, really, for me, the global litmus paper of this inflation shock. And what is so important is the Bloomberg Dollar Index is a true 2.6 standard deviation move. And, John, it's expressed not only in the majors like Euro under 115, but also in EM. John, what does this inflation of the United States mean for emerging markets? I think that's a story in the coming months.
They are already hiking, Tom. It's the inflation story worldwide, and we've seen some big hikes from the likes of Brazil and others, and maybe not so much out of your Turkey, which I know you watch very, very closely. They're going the other way. Chris Marangi joining us now, co-CIO of Gabelli Funds on this equity market. Chris, we've got to start there, haven't we? How did you react when you saw that 6 handle on CPI in America?
Well, unfortunately, not with a lot of surprise. We're just getting through Q3 earnings season now, and unquestionably, the theme of all these calls, whether it's autos or food or even the Walt Disney Company last night, is inflation and supply chain issues, which inflation being one manifestation. Everything is transitory in a long enough time frame. This doesn't look like it's changing anytime soon from what we're hearing from companies. Freight is probably going to loosen up first, but semis are going to take a longer time, and labor, we don't know.
Chris Marangi, how do you inflation-proof a portfolio? A measured value, Mario Gabelli's a certified starred portfolio. How do you inflation-proof it?
Well, the reality is that there's no way to inflation-proof it, and not something that equity managers have had to think about for decades, really. Notwithstanding that, there are ways to limit the impact of inflation, looking for companies with pricing power in particular, and then the nirvana is really to find companies with both pricing power and fixed costs. Waste companies I've talked about before. It doesn't cost more to get rid of garbage in a landfill that's already paid for. So we're looking for those. We're looking for stores of value, just like everybody else. I think the whole inflation, the prospect of inflation has driven the crypto market.
So if you look at gross margin, or you bring it even down to a healthy EBITDA, big percentage margin that helps you with that inflation proofing, does that steer you back to big tech?
Well, there's no question that at least some of the big tech companies, Google comes to mind, have enormous pricing power and are in many ways inflation conduits. Then we think about, okay, well, what's the impact of interest rates? And obviously, higher interest rates probably more impactful on those companies that have cash flows well into the future. So we've got to balance those things.
Chris, it was Warren Buffett who came out and said, only when the tide rolls out do you discover who's been swimming naked. Is the tide starting to roll out right now?
Well, we know that the tides come in and out. We don't have a great schedule for that at the present time. But yeah, I think we're probably closer to the tide going out. Notwithstanding that, listen, Rivian's got an $85 billion market cap. So this isn't changing yet.
At what point do we start to see some real disruptions, however, where we see the most vulnerable players shaken out?
Yeah, I think we're already starting to see that. This will an inability to pass along cost will cause financial pressure, will cause pressure on debt service for a lot of companies that have leverage. And as the debt markets perhaps tighten up, they might not be there for those companies. So this is a process that probably plays out over time.
Can you weigh in on that, just briefly, Chris, that we've got an $86 billion market cap on an automaker that only just started delivering vehicles a couple of months ago? How do you respond to that, Chris, someone like you?
Yeah, someone like me who owns GM, which is a very similar market cap and obviously a much larger market share. It's puzzling. Listen, without Amazon, I don't think they'd have nearly the market cap that they do. But Rivian appears to be a real company. But it's challenging to actually make stuff, make cars, get them delivered to customers, service them, and all those other things. So I think it's going to be a bumpy road for that company. But they're probably going to be a good competitor.
Have you bought it, Chris? Did you buy the stock?
No, we have. We like to participate in some of these stories through suppliers, and one of the suppliers to Rivian is a company called Tenneco, a little teeny tiny auto supplier that makes a suspension for them. So that's one way we play it.
Let's see if they can ramp up production in a big way. Chris, great to catch up. Remarkable moment for that industry. Chris Morangi there of Gabelli Funds. Tom Keene, an $86 billion valuation. For reference, the Ford Motor Company, $77 billion.
I don't know what to make of it, John. I have the clearest memories of the profit illusions of 99, 2000, and then it was reported out in 2001 what a fiction it was. I'm not suggesting that now, but John, in some sense, it's a silly season. The things change, but the silly season's always there in a boom.
GM, 86 billion, Lisa. 86 on Rivian. Is it easier to transition to EV or easier to start from scratch? Because for the likes of Rivian, there's a belief that starting from scratch is more than doable.
Well, Marky Patel yesterday coming out and saying that she sees a bubble in the electric vehicle space, and there are others that might agree. But, when Tom talks about the silly season, we only know it's a silly season when it stops, and what is going to stop it? And I do wonder, at this point, are we starting to see the beginning of that with inflation, or does it persist? Because long term, it will curtail growth, and you'll end up with lower yields. It's sort of this new normal, and then stocks continue to go up. I mean, I just wonder at what point do we get a reality check on some of these valuations?
Who's ready to lean in and push back against the communication we had from Chairman Powell in the last week? Who's ready to do that?
Honestly, I think that that's what's going on with the market. The market is leaning back and saying, you're going to probably end your bond purchases sooner than expected, and probably you're going to be raising rates at least 2 times next year. That's what the market is saying.
He looks pretty reluctant to make a move, doesn't he, so far? At least. Tom Keene, Lisa Bramis, and Jonathan Ferro. Middle of December, your next Fed decision. Expect some changes to the forecast.
Wait.
Going to be some very interesting changes
Ferro
to the
takes
forecast.
off like 3 weeks or 4 weeks.
I'm ready to go. Once we've done that, I'm out. I'm done for the year.
You said that like a month ago.
Year over. I mean, I haven't been here, Lisa. I've been missing for the last 2 months.
Capri awaits.
Let's face it. Equity futures up 16. We're up 1/3 of 1%. From New York City, a beautiful morning. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Tesla CEO Elon Musk has sold $5 billion of shares in the electric car maker. That was shortly after holding a poll on Twitter on whether he should sell 10% of his giant stake in the company. The world's richest person has sold more than 4.5 million shares this week. Those were his first sales since 2016. China's President Xi Jinping is set to deliver the first resolution on Communist Party history in 40 years. That's expected to give him the mandate to potentially rule for life. Only Mao Zedong and Deng Xiaoping have authored a so-called historical resolution, and both used them to dominate party politics until they died. SpaceX has launched its third crew of astronauts to the International Space Station. The Falcon 9 rocket and its crew of 4 lifted off late Wednesday from the Kennedy Space Center. It's scheduled to dock with the space station later today. The astronauts will then begin a 6-month research mission. And shares of Disney are lower today. The world's largest entertainment company reported a smaller than expected increase in subscribers to its namesake streaming service. That was only part of a broadly disappointing quarterly report. Disney sales and profit both missed estimates. And Starbucks has lost an attempt to stop unionization votes at 3 of its restaurants in the Buffalo, New York area. The U.S. government has now mailed ballots to workers. A union victory in any of the elections would create the first such labor foothold amongst Starbucks' thousands of company-run locations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
So you
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did
I
he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Many people remain unsettled about the economy, and we all know why. They see higher prices. They go to the store or go online, and they can't find what they always want and when they want it. And we're tracking these issues and trying to figure out how to tackle them head on.
It is the big issue in this country right now. That's the President of the United States. From New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market this morning up 16, advancing a third of 1%. The shape of your market as follows. Yesterday, yields at the long end higher, much higher. Today, we are closed in the bond market for Veterans Day. In the Bund market over in Germany, yields come in about a basis point to negative 26. In the FX market, euro dollar negative a 114 handle, 114.57. And crude, a break of 81. We're down 40 cents on the session, off by 0.5 of 1%, $80.88. It took Senator Manchin 1 hour and 8 minutes to respond to the CPI print on Twitter yesterday. The threat posed by record inflation to the American people is not transitory and is instead getting worse. From the grocery store to the gas pump, Americans know the inflation tax is real, and Tom, D.C. can no longer ignore the economic pain Americans feel every day. How much did that inflation print change the negotiations down in Washington, Tom, for the president's next big effort?
Well, the negotiations not only for the next big effort, but also the political path to the first Tuesday of November next year. It seems distant in Washington. It's not. Jack Fitzpatrick with us now with Bloomberg Government. What changed yesterday, Jack? What changed yesterday in terms of the political heat? We need to spend more money because that always works versus this inflation print.
It amped up the pressure. Obviously, Senator Manchin is front and center on this issue because everybody on the Democratic side is looking to him and Kyrsten Sinema. Even before the report, there were Democrats trying to emphasize that this bill is meant to be paid for. That doesn't negate the fact that a lot of the spending in it is more front-loaded in the earlier years than the revenue, so there could be some inflationary pressure from this reconciliation bill. But really, it just amps up the dynamic that we've seen for months, which is the question of how deeply will Senator Manchin and also Senator Sinema dig in their heels on this bill over the inflation concerns.
Over the inflation concerns, but come on, they're not linked. Every textbook tells me that. Jack, why in your world are they linked?
I'm not clear on the question. The linked to
well, you
this
got a
bill.
Fiscal policy. You got a set of fiscal policies going back umpteen months here in this pandemic involving trillions and trillions of dollars. We all understand that. Whatever our politics, we have inflation. There's a big debate about that. I get it, but why are they linked right now in this legislation? If we cut $300 billion out of this program, what does it actually do to a gallon of milk at the grocery store?
That's probably where 2022 comes in, because yes, this bill would have a much smaller effect than anything you've seen in terms of the supply chain management, a number of economic issues that play into this. And really, it's the talking point. Even if it were entirely paid for, to go for a $1.8 or so trillion bill gives Republicans exactly what they want, and moderate Democrats something they don't want, which is a big number in terms of government spending at a time when there's inflation. This would not be the main cause of inflation, but it would be a cause of serious heartburn for Democrats on the campaign trail more than anything else.
Jack, Joe Manchin wasn't the only one to swiftly respond to the CPI print. President Biden also responded. And in his discussion of why it was sort of highlighting the need for the infrastructure plans that he's put out there, he also said that he has a commitment to the Fed's independence to monitor inflation and take steps necessary to combat it. What does that mean?
Well, part of that is probably just a response to the talk, one, about whether the president's going to look for a new Fed chair, but also keeping in mind the politicized pressure on the Fed chair that came up in the last administration. That's a fairly broad statement that doesn't necessarily mean that much from the president, other than I think a promise to generally support the Fed's independence.
Okay, well, given that, it is that much odder that we have not heard from President Biden in terms of nominating a new Fed chair. This is an anomaly. In the previous 1, 2, 3, you can name it, administrations, there already was somebody named and well on their way to confirmation at this point in the year. Why the delay?
I think at this point you can look to the pressure from progressives as at least a reason for the delay. Not that we've had a breakthrough in terms of actual news that the president would look for someone else. You've heard some indications of support from members of the administration, including Janet Yellen, for Jerome Powell. But yes, it is a bit of an aberration and definitely noteworthy. And I think the number one sort of point of emphasis that's tied to this is the number of progressive lawmakers in the Senate who are saying they'd like to see somebody else.
Jeff Fitzpatrick, we are remembering Armistice Day, that is Veterans Day in America. The Vice President of the United States is in Paris. That is not unusual. That is, I think, highly symbolic of the relationship of the two nations. What is the story this time around? Not that modest uproars ensued, but I would suggest almost a mystery over the Vice President's visit to Paris.
Yeah, there hasn't been a ton of news from the vice president's trip. They're talking about cybersecurity issues, cooperation in space. Probably the bigger piece of news is that reportedly, according to our colleague Jennifer Jacobs, they did not talk about the blow-up over the submarine deal that the U.S. got involved with via Australia. So it probably more is a matter of the vice president's profile. One, because her focus on border issues has not been particularly easy for her, and two, just the Biden administration trying to reach out to Macron and the French government and try to have a presence in some way that's positive and isn't quite so uncomfortable as previous meetings over that submarine deal.
Hey, Jack, good to catch up, sir. Thank you. Our Bloomberg government reporter down in D.C. Lisa trying to tiptoe into the realm of speculation. I just wonder where you were going. I'm going to ask a question. Are you suggesting that maybe Chairman Powell starts to become the fall guy for what's happening with the inflation picture in this country?
Honestly, I did not understand what President Biden was talking about. Is he saying that? Is he saying that this is their independence? I have nothing to do with how quickly inflation picks up, and if it goes too quickly, then are we going to basically say to the Fed, you screwed up? Or is this his way of just saying that the Fed is there and hinting at a nomination? I don't know what the purpose was of that statement, John.
You're not the only one asking it. Tom, it's a question that many people are asking.
It's a debate now. And, you know, the separation here, John, is tangible from what is clearly real inflation. Folks, look at the rents in New York City if you want to go personal. And then the other thing, John, is the academics of it, the economics of it. Yeah, there's some arguments there. I like what Adam Posen has said is we better get used to 3% inflation.
Adam Posen's saying embrace it, Tom. That's the difference. Not just get used to it, but embrace it.
Yeah.
He's suggesting this is a sign
John,
of success. It's well said.
It's well said.
I'm not saying I agree with Adam Posen. I'm just suggesting, Tom, that's what he's implying.
It's well said.
Thank you. See how this is going this morning.
Oh boy.
Did you see Harry Kane and the remembrances? They showed English football with Harry Kane.
The national team together for
I
the
almost teared up.
international break, Tom. Equity futures up a third. This is Bloomberg.